Hi everyone, welcome to this refresher course on international tax. Before we start with our sessions, let us all be attentive to our institute's motto. Can you please start, Vijay?
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्द्वैता 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 एतद्द्वैता
Thank you. So friends, we are starting now our international tax refresher course. As you know, the program is totally packed right from digital economy to equalization, levies to international tax, transfer pricing, and then managing the tax risk as well. So essentially, I think Drishti ma'am has joined also. Ma'am, welcome to this session. Would you like to start? Sorry, in the interest of time, I just kick-started the sessions.
Sure. I had some network issues, so I had to change my network. That's why it took me some time to log in. So, first, thank you very much, Rakesh, for this wonderful program that you have helped us put up at WRC. I really welcome the faculty, C. Rawal. I think this means I've heard so much about your the expertise that you have, and I'm sure there's a lot of takeaway that the participants here will have from this session that you will take. Now, a few things that we are doing at WRC. In fact, we have all the programs that we have been conducting on this platform on virtual mode, and because of that, it's all recorded and they are all on the YouTube channel of WRC. So they can become, a training resource for all the participants, and even non-participants they can use this as training resource and also updating resource. So this YouTube channel of WRC is something that I feel all the members should subscribe to, because it's invaluable, the kind of resource we have over there. The other thing is that we have also started 3 new study groups on WRC platform, and that is one on direct tax, there's another one on this internal audit, and there's third one on valuation. Every month we are having in-depth discussions on a select topic, and it's an open platform for discussion. So it's really very, very useful for the members. So I request all the members to, whoever wants to join can join these study groups. So that's about it from my side. I don't want to take away more time of the faculty. And I really thank the faculty, Radhakishan for having joined us and for taking this session. Over to you, Rakesh.
Thank you, Drishti ma'am, and all the efforts also for selecting the topics as well as the faculties. A lot of to and fro, and brains have gone to decide the topics as well as the speakers, and I'm sure that each topic itself is a specialization type of topic. And I have the pleasant task of introducing Mr. Radhakishan Rawal, which we very friendly call him as RK, and he loves to call himself also RK. RK as such has more than 20 years of experience and has been speaking on international tax on several forums. His books are not only being read in India but across the globe on international tax, and we are really blessed to have him here. He is going to touch upon a very important topic today, which is the digitalization. While we always felt that digitization is something which software companies has to deal with, but today if you look into digitization has gone into every aspect of our life, and every transaction therefore is impacted with it, and that is creating a lot of tax issues, a lot of tax clarifications. On top of it, what RK is going to take us today is the new concept of Pillar 1 and Pillar 2, which the OECD has recommended, and that's very, very interesting. It's going to open up a Pandora's box of how do you do your taxation, the Nexus rules, the transfer pricing regulations, and it's going to be very, very interesting. On top of it, this Pillar 1, Pillar 2 itself is a big specialization. Yesterday, I was with RK for almost 3 hours. We were debating on this subject, and still we could not complete, and we have agreed to go for a second session. So that's an interesting topic, and a new totally plain vanilla, which will be coming from next year in India as well. So that's something, RK is going to take us along with other aspects of digitalization. So welcome RK for this session. And before I request you to start your session, we also have our beloved chairman Manish Bhai on the screen, and I would request him to share his thoughts on this particular whole refresher course that we are starting today, and trying to cover as many topics as possible, which are giving new avenues of business for the chartered accountants. Yeah, Manish Bhai.
Thank you, Rakesh Bhai, and really indeed a great pleasure that you have structured this series. You along with Dosti Madam has really put up lots and lots of effort for structuring this program, coordinating and all that. And Dosti Madam structuring a question for panel discussion and everything. It's really a great team effort. So it's a good series, and I will say the participants are really going to enjoy. So thank you very much. Over to you, Rakesh.
Thank you, Manish Bhai. Thank you, Rishi ma'am. So RK, the stage is yours. We are all eager to hear you.
Sure. Thank you very much. Good morning, Manish Bhai. Good morning, Mrs. Desai, Rakesh, and all the participants who are present here. It is indeed, my pleasure to be here and share my thoughts on the new developments with the fellow practitioners. I thank WRC for giving me this opportunity. I hope my screen is visible. Is it?
Yes.
Yeah, fine. Okay. So the topic of the day is taxation of digital economy, and then the way I see this topic is that one, we have to see the developments at a global stage, and then how is India reacting to it. So I have divided this presentation into 3 or 4 baskets, so to say. First, we'll take a broader perspective in 2 or 3 slides of what's happening globally. Then we see how is India reacting to it, and then we get into some of the 2 or 3 aspects into a greater detail. So let's first understand what's happening globally and why it is happening. So this all started somewhere in 2013. And the thought that time was that the MNEs are not paying fair share of their taxes. There's a lot of base erosion and profit shifting happening. So it started with a program called BEPS, base erosion and profit shifting, in 2013. And there were 15 action plans. One of the action plans, the key one, was about the digital. And the digital was one of the most important aspects because what had happened was that the current treaty rules, especially the concept of P, that was structured or created maybe 100 years back. Now when we see the business models have completely changed, and the P concept as such proves to be outdated, and it's not possible to have a fair distribution of taxing rights based on the P concept. And that got recognized, maybe somewhere in 2000 itself, Okay, and there were other reports dealing with this issue. But somehow, the thought was that, well, we will continue living with PE concept, and we'll, try to get some other solutions. But finally, they said, okay, fine, now it's not possible to continue with PE concept as far as digital economy is concerned. So we need to think through a new topic, and that's where Action One, was a part of it. We saw, the 15 action plans, final reports coming in 2015 itself. A lot of them are already implemented in the form of various provisions in the tax treaties, MLI, as well as domestic law. But what remained outstanding was the work on digital, and that work is still going on. In 2018, we saw an interim report, on how this could be progressed, and they came up with 2 or 3 approaches. And finally, in 2020, October 2020, we had 2 reports, of Pillar 1 and Pillar 2. These are 2 blueprints, both taken together, are running to almost 450 plus pages, and very complex solutions they have come up with. So that was technical work, and the technical work is still continuing. And then also there's also an issue of political consensus. So there are 139 countries working together in inclusive framework. What we see, what we have seen so far is that, as per the June communication, 130 countries agreed on it. So the way it happened is that first there was a G7 agreement, then there was a G20 agreement, and then the inclusive framework said, okay, fine, now we have a political consensus as well. So 130 countries, agreed to begin with. Thereafter, 3 more countries joined. And as of date, when we speak, we have about 6 countries who are yet to kind of, give the consent for this global solution. We had a statement from Framework on 1st of July, and we are expecting the next final kind of agreement on work on remaining issues by the end of October probably, and that the plan is to implement the entire thing by 2023. So it's happening too fast. The deadlines are indeed aggressive in nature, and a lot of things will happen in next 1.5-2 years. Now let's see how is India reacting to it. What is the Indian response to taxation of digital economy? Well, India is a very active participant within inclusive framework as a part of G20, and we have a reasonable say, in the entire proceedings. And India is also, kind of a country which is, we take the first initiative. So we are the pioneers of equalization levy. So let's see how it happened in India. 2018 report, had suggested 2 or 3 options. One was EQL, one was SCP. So India incorporated both of them in the domestic law. In 2016, we saw equalization levy coming up, as a new tax, although it is outside the Income Tax Act. So the treaty benefits are not available. So in 2016, the first version came, and that was a tax on online advertisement and related services. EQL was levied at the rate of 6%. We saw a next, next wave, so to say, of EQL, with the expansion of scope which happened in 2020 with the first of 2020. They levied EQL on online sale of goods and service and provision of services at the rate of 2%. Fairly complex thing to happen, and this is a separate topic by itself. So we have a next session. Next speaker is going to deal with that. Then we saw the concept of SCP, significant economic presence, also getting inserted in the domestic law. This first got inserted in 2018. However, it was never activated because the required thresholds were not provided. Finally, in 2020, they kind of reintroduced the concept, and effective April 2021, the concept of SCP is active. They also have provided the required threshold to make this provision work. So they withdrew the old provision, made some minor changes, and reintroduced the provision, and now the provision is operational. So the profits, which are arising as a result of SCP, are subject to tax in India on net basis at the rate of 40%. although we are yet to come up with the rules for determining its profits. So government has taken powers to come up with the rules in section 295. When do they come up with with the real rules? No, probably we have to wait and watch. But there are several open areas as in this regard. The next provision is explanation 3A to section 911, and that is income from advertisement and sale of data and products. Using the data captured from India. This is also a new provision targeting digital. The tax will be levied on net basis at the rate of 40%. Explanation 2A and explanation 3A are both in section 9, and they are sitting within the provisions of the Income Tax Act. So the benefit of tax equity is available in these cases. We're going to look at explanation 2 in little more greater detail in the subsequent slides. The other things which are happening was 94O, which is a TDS provision. We had section 52, which is TDS within GST law, and also concept of OIDAR within the GST law. So that was the whole approach of India to levy tax on digital businesses. Now, if I try to plot this provisions, in a diagram form, I get something like this. I mean, it's not, absolute, scientific diagram, but we see a lot of provisions which overlap each other, and one has to really navigate, as to which is the right provision to apply. So we have section 911, the traditional concept of business connection. What Supreme Court said in R.D. Agrawal. One may want to explore application of that concept itself. However, they thought of further clarifying it in the form of explanation 2A and explanation 3A. And equalization levy is a levy outside of the Income Tax Act. Now, having said that, if one wants to stretch or apply the concept of income accruing and arising in India, okay, one may say that, well, that's also broad enough, to cover this transaction. And we have, some celebrated cases, like Performing Rights Society of Supreme Court, which I see relevant today itself. And if I start applying that ruling, it also may give some results. So we have a lot of provisions, which are kind of overlapping each other in the domestic law, and then we have, the tax equity developments. So with that, let me go into a little more detail of explanation 2A, which is significant economic presence. This is a basic provision and rule, so I'll not read through those provisions. But essentially, explanation 2A is now part of section 911, and it essentially says that a significant economic presence constitutes a business connection. Why it constitutes a business connection? Because in the section 911, business connection results in taxable income, and there is a definition of SAP. It says transaction in respect of goods or services or property carried out by non-resident with any person in India, including provisioner of download of software or services. And the threshold which is provided for this is 2 crore. And there's a second limit to it, which says systematic and continuous solicitation of business activities or engaging in interaction with users. And the threshold which they have given there is 3 lakhs. And then it further kind of purifies or improves the provision by saying that a non-resident will have a SEP in India, irrespective of whether the agreement is entered into India or non-resident has a residence or a place of business in India, or the actual services are rendered in India. What about attribution? It says only so much of income as is attributable to the specific transactions or activities is to be deemed to occur as in India. What is to be noted here is that when we look at section 911, okay, it makes a reference to operation from India, and they are cautious to ensure that the word operation is not used in this provision. And let's understand the reason why. The reason for that is that when we look at explanation section 911, there is an explanation which provides that where all the operations not carried out in India, only income which is relating to the operations in India, reasonably attributable to the operations in India, is deemed to be accruing in India. Now, what they have done is that they have excluded business connection on account of SCP from this provision, and they have taken it separately. So while this provision makes a reference to operations carried out in India, when we look at the rule for attribution in explanation 2A, it does not use the word operations in India. Let's look at some of the issues arising from subclause 1A. The issues are, uh, does this cover physical goods? Does it apply to non-digital services? Does it apply to non-digital property? And these issues arise, because of the language which they've used, and also some of the other observations, which are made by the authorities in public forum. So, typically, to understand the meaning of any provision, we'll go to explanatory memorandum. Explanatory memorandum, makes a clear statement that the purpose is to, kind of target the digital businesses which are carried on without any physical presence, do not involve physical goods. We get that kind of a flavor from there. However, when we read the section is worded in a manner that it can be applied to physical goods as well. So the real scope is going beyond digital. And similarly, when we look at, we hear to the various government authorities, speaking from public platform, it also gives an indication that the intention is to, they intend to apply this SEP to something which is not essentially restricted to digital. Now, having said that, if we just take a step back and see what is happening globally, we're going to look at it in far more detail. But even for Pillar 1 and Pillar 2, with the expanded scope now, they've gone way beyond digital. So when they started, the idea was to tax digital, automated digital services. But from there, they included CFP, consumer-facing businesses. But now, it's like all businesses. So while the title of the, of the project or the blueprints will save digital businesses, however, in practice, in reality, it has gone far beyond digital. And we see the same thing happening in the domestic law as well. The second issue here is about, what about attribution of profits to transaction activities? How are we going to calculate the profits which are attributable to transactions and activities? As I said, the government has taken powers under Section 295. However, it's a discretionary power. They come up with the rules, and if they don't come up with the rules, there will be a question mark. Would the existing Rule 10 be applied in the current form? So, that's the question which probably remains open from here, because about 2 years back, the government did come up with a revised draft Rule 10. However, a good consultation happened. It was almost 80-page report, but nothing has happened after that. That rule is kind of kept as it is. Now, if we see in a broader perspective, and we look at these provisions, what is happening is that, while things are developing at a global level, the government is also trying to create relevant provisions in the domestic law. And the idea is that, you create some infrastructure, for, let's say, for taxation of digital in the domestic law, and where, where there's a global consensus, the global provisions are finalized, probably this could convert somewhere. That's the reason when we look at equal provisions and some of the complications, what we hear from the authorities is that they saw it as an interim kind of a thing, and once dust settles, globally, the final global provisions are kind of agreed upon. They may do corresponding changes in the domestic law, and the domestic law provisions may also stabilize thereafter. So let's look at some of the issues arising from subclause B. And then there are, I would say this is a big ground for litigation. There are several issues which need to be answered and interpreted, and the words which they have used are all open for interpretation. So what is the meaning of systematic and continuous solicitation of business? So if I get an SMS for a new housing project which is launched once in a week, is that systematic and continuous, or someone should be calling me twice a day to call it as a systematic and continuous? What is systematic and continuous? These are very subjective terms, so to say, difficult to measure what is systematic and continuous. Another thing that they use is engaging in an interaction. Now, what is an interaction? Does interaction mean a two-way communication? Or if someone keeps on sending email to me, even if I don't respond, that is an interaction. I would want to say that interaction is probably, it should be a two-way communication, but these words are open to, interpretation. Again, there's a reference to user. Now, who is a user here? If I surf a website and if I happen to see a particular ad, am I a user? Or to become a user, I should have some sort of a membership with the organization. My details should be there. I should be a regular customer of that entity to call myself as a user. These are the issues, which are going to come up. And unless we get a good guidance from the authorities, we'll have litigation on this in the years to come. Again, there are issues like how to find number of users. Should be registered users. Or the messages sent to X number of people. They are all the users. We'll have some guidance. We need some guidance from this. We have some guidance under Pillar 1 sourcing rules, which we'll see in subsequent slides. But there are a lot of these issues which kind of remain unanswered. Now, what's going to happen is that the provisions of tax treaties, do override the domestic law. And for that reason, probably, these issues may not become that important, at least in those cases when the treaty benefit is available. Because in those cases, these issues are probably, when they say the treaty benefit is available, so need not be answered. There is indeed an overlap, within Section 9 itself. So if we see this provision, we have provisions dealing with goods, services, and properties in the concept of SEP, as well as we have similar comparable provisions in the context of royalties and FTS as well. So services could be taxed as FTS. Consideration for property. We see property getting utilized in the definition of a royalty. So there is an overlap, and the question would be, which provision should be applied there. A general principle is that whenever there's a conflict of provisions, a special provision would override the general provision. The issue here would be, which is a general provision and which is a special provision. Another legal principle is that, you look at the provision which is coming later in time. If that is the case, then Section 911 explanation 2A and 3A are later in time, then that should prevail. If we think so very carefully, can the intention at all be to apply Section 911 as against Section 916 or 917? 916 and 917, although we have a lot of litigation, but I would say the provisions have by and large settled so far. These provisions came in 1976. However, by now it is, we have a very good amount of guidance on these provisions. And one may want to say that, well, probably the intention is not to apply Section 911, as against royalty FTS definition. We have seen the same thing happening in the context of, Equal as well. They brought back saying that first we'll apply royalty FTS definition and then Equal. So these are the issues which are going to come up. This is, in a way, summarizes what I said earlier, so I'll not maybe spend time on this. And this is going to, raise some of the compliance issues. And, I've divided this in two parts, where the treaty benefit is available and the benefit is not available. The first question would be, is there an obligation to file return for a non-resident if the non-resident has a business connection in the form of SEP in India? So in India, there is an SEP under the domestic law. There is an income chargeable to tax. However, under the treaty, because there is no P, income is not chargeable to tax. So this is going to be an issue, whether the non-resident should be filing a tax return or not. In my view, my personal opinion is that in all these cases, non-resident has an obligation to file return and let the officer examine the availability of treaty benefit. Similarly, there will be obligation to withhold taxes. How do we apply Section 195 in these cases? So there are some other incidental issues which would also arise. And one specific issue which I want to highlight is that when you look at the definition of foreign company in Section 242 of the Companies Act, okay, there's a specific reference to electronic mode operations, and one may want to examine whether a non-student having an SAP India gets covered within this kind of provision. One also needs to see what is the implication of Section 163, because agency gets created, or 163 gets created on account of business connection non-resident. So these are some of the issues which do arise from SAP. They are really complex issues, but the issues are probably restricted to cases where the kit benefit is not available. I would want to believe that government at some point of time will have to clarify a lot of the issues, and if they don't do it, we're going to have a good amount of litigation on interpretation of this provision. With that, let me move on to the next major global development, which is Pillar 1. Pillar 1 is essentially, the solution which they started with to give taxing right for digital businesses. However, as I said here earlier, now when we look at it now, it's gone way beyond digital. So the scope has really expanded. But essentially, what it does is that it's giving a new taxing right altogether to the source country, to the market jurisdictions, to levy tax without the non-residents having a P in the market jurisdiction. So this I would say a biggest change to happen in the history of international taxation, because for almost 100 years we've kind of grown up understanding that to levy tax on a business profit there must be a P in the source country. The concept of source country and the concept of market jurisdiction is kind of getting mixed up, and now there's more importance to market jurisdiction, and that's become so because of the revenue sourcing rules. We'll look at that in the subsequent slides, but this is a new taxing right which is coming up. They call the new taxing right as amount A. Maybe they may have started a small group, and they started giving they had to use some term for this taxing right, and they thought of calling it as amount A. Then came amount B. Amount B as such is not a new taxing right, that's an existing taxing right, and it is trying to resolve or the disputes which often arise on the baseline marketing and distribution functions performed in a market jurisdiction. So what it is trying to do is that it will define a set of activities which will qualify as a marketing and distribution functions, and they would be entitled to a fixed baseline return. And if the countries agree on this, that means there should not be a litigation on this transfer pricing litigation on this aspect. So that they call it amount B. Earlier drafts, they had a concept of amount C as well. Now they are calling it as a tax certainty, and which is in the form of effective dispute prevention and resolution mechanism. So there's a detailed guidance or as regards how do we try to ensure that there are no disputes as regards amount A largely and amount B they're trying to get into it. And that happens in a different mode. This is not a traditional way of resolving disputes in the Lake Commission of Peace or Tribunal or High Court, not even MAP. It's a completely new mechanism to avoid disputes. Before that, let me just okay, and I'll just go as per this. Now this diagram is is giving a much broader understanding of what's happening. We're talking about profits of the M&E group. Okay, we all understood so far in practice taxation vis-a-vis a company. Okay, we always consider calculate taxable income of a company and levy tax on it, assess that income. However, here under Pillar 1, they're looking at tax of total profits of M&E group, which are all required to consolidate the financial statements. and the profit of the group is determined. Now, a part of that profit, which is up to 10% of PBT, is treated as a routine profit. And the profit before that is treated as a non-routine profit. A fraction of non-routine profits, it could be in the range of 20% to 30%, is allocated to market jurisdictions in the form of amount A. So, I mean, when you keep on saying amount A, the topmost blue portion, which you see on the diagram here, okay, which is a fraction of 20 or 30% of the non-routine profits, is treated as amount A, and it gets distributed in the market jurisdictions. And we'll have an example to understand this better. We've spoken about amount A and amount B, and the blueprints give a lot of guidance on what is amount A and amount B. But when we try to add up, we come to a conclusion that that doesn't add up to the entire profits. So the top portion is amount A. Maybe a part of the below portion, which is routine profit. The routine profits towards the marketing distribution activities is amount B. But still, there's a lot of profit left in the entire bar, and that profit I would call it as amount C. Now, the blueprint, or the OECD solution does not attempt to give any guidance on this amount C. That means the existing treaty rules will continue to apply for this amount C. So, depending on what happens, what activities are performed in the market jurisdiction, the market jurisdiction may get amount A, B, C all together, or EOB or EOC, in whichever combination we can think of. Now, let's take a very simple example to understand, how this profit allocation going to happen. So, we have a situation where a group, we are calling it as a group, it's not a company. A large M&E group is providing services on an online platform. And this example is coming, directly from the blueprint. So I've tried to, I've retained it as it is, without making the modifications. So a group's total revenue is 25,000 euro. The profit before tax is 6,500. So PBT margin is 26%. So this is above the threshold. Now the group has this revenue sourced from 3 markets, 3 countries. In the first market, there is a local subsidiary. In market 2 and market 3, the subsidiaries or the physical presence are not there. So they are all remote activities. So that's the total turnover of the group. Now the amount A working, as I said, the profits about 10% of PBT is called residual profits. So that amount comes to 4,000, and 20% of that is amount A, which gets distributed to market jurisdictions. Now, how does this amount get distributed? That gets distributed on the basis of the turnover achieved in each of the respective states. So it's just simple proportionate working to allocate the amount. Now let's understand some of the numbers here. Where does 10% come from and where does 20% come from? They call it simplifying convention, for the reason that ordinarily, if one were to calculate this amounts based on hardcore transfer pricing principles, it would be very much complicated exercise. And to make it simpler, okay, they said, okay, fine, let's presume this amount. Let as a group agree on these numbers. So the group has agreed on 10% as a profitability threshold, and the proportion in this example is taken at 20%, but they're still talking about range of 20 to 30%. So they will have to agree on that number. So this is a very simple and basic understanding of how this allocation happens. Now in the subsequent slides, we'll try to see some of the concepts which are used in this working. So the blueprint essentially has 10 chapters. The first chapter, gives us kind of an executive summary, and then the remaining chapters, deal with each of the concepts. So let's start with the scope. Okay, as I said earlier, when they started with, the initial scope was automated digital services and consumer facing businesses. However, after the US government started participating, what the revised proposal, on which 133 countries have agreed so far, is all businesses, except extractives and regulated financial services. So all businesses are now covered, and it's not applicable to all entities. Earlier, the threshold was 750 million euro. Now it has been increased from 750 to 20 billion. That means the threshold has been increased significantly. And again, this entity should be profitable. So an entity would qualify only if there is a profitability beyond 10%. If a particular group has 20 billion profitability, 20 billion turnover, but profitability is below 10%, then that group will not qualify, except it's considered as a part of a particular segment. So that probably that's far more complex, so we don't get into it for the moment. But this is a global threshold. As we speak, the estimation is that probably there are 80 to 85 groups in the entire world who will qualify for this threshold. So the population per se is much smaller, in that sense. However, they intend to observe how this solution works for 7 years, and after 7 years, they intend to reduce the threshold from 20 million to 10 million. Next is, the concept of nexus. So the question is, who gets the right to tax amount A? So there are a number of countries in which there will be a turnover as per the revenue sourcing rule, but all the countries will not get a taxing right, and that's because that they have agreed on threshold. The thresholds are in two numbers. One is the countries having GDP over 40 billion. The threshold is 1 million euro, and the countries which are smaller, they have a GDP of less than 40. The threshold is 250,000 euro. So only if the revenue derived from a country is crossing this threshold, only then the country gets a right to tax. So I'll try to create a very simple example of how this nexus rule is to be examined. So in this example, the group has presence in almost 20 countries. The group is deriving revenue from these 20 countries. However, the taxing rights will not be given to all 20 countries. Taxing rights will be given only to those countries which is crossing the threshold. So if we talk about, let's say country 2, the GDP is higher than 40 billion, so the threshold is higher, which is 1 million, whereas the revenue derived from country 2 is 2 million. So this country will be qualifying for a fraction of amount A. So based on this, they will decide which country qualifies for amount A and which country does not qualify. This is quite unique in the sense that when we look at the current tax treaty rules, the source country gets taxing right, even on a single dollar of, let's say, interest or royalty or FTS. However, here for administrative purposes, they have taken higher threshold. The next is revenue sourcing rules, and this slide just kind of refreshes our memory as to what do we understand by revenue sourcing. When we look at the current treaty rules, we find this provision in our articles dealing with interest or royalties or FTS, and typically where the interest or royalty or FTS is paid by a resident of a country, the income is sourced from that country. Or if the such income is paid by a PE of a non-resident, and PE claims a non-resident claims a deduction for tax expenses, then the income is sourced from their country. Now, this is the sourcing rule which you understood so far from tax treaties. For Pillar 1, the sourcing rules are different. What they intend to do is that for every type of business, they would come up with a different sourcing rules. And the idea here is that the payer may be X, however, the real consumer may be Y in a different country. So they want to give taxing right to the countries where the real customers, the real users of the products, goods and services are situated, and the rules are designed in that manner. So there's a detailed guidance on this, and I'll just give a glimpse of it here. So let's say for ADS businesses, they have identified different streams of revenue. They identify different types of revenues. So the revenue could be from online advertisement services, or from sale of other goods, or sale of user data, and so they've narrated all the types of revenues one can think of, and then they have also created the sourcing rule, and there are indicators. So these are to be followed in sort of a hierarchy. So for online advertisement services, which is based on real-time location of the viewer, the sourcing rule is that one has to see these indicators, and the jurisdiction, the country of the real-time location of the viewer is the one from where the income is derived, from the income is sourced. And how do you identify the jurisdiction of the real-time location of the viewer? There are three indicators. One is the jurisdiction of the geolocation of the device, of the viewer at the time of display. If that is not available, then you go to the next one. You rely on the IP address, of the device of the viewer. If that is not available, then you go to a third one. Then you look at the other information which is available. So there's a hierarchy of indicators, and one is supposed to follow this hierarchy to identify the location where the viewer is watching the advertisement, and the country from where the advertisement is accessed is the country from where the revenue is sourced. So let's say if I'm traveling to US, and if I'm watching a particular advertisement there on my internet, then my IP location may be shown as in US, and the revenue related to that advertisement will be shown as source from US. So that's how they are trying to ensure that the jurisdiction in which the user is located is able to get the taxing right. So we have some rules available in the blueprint. These rules are there only for ADS and CFP. Now they have really enhanced the scope, and a lot more businesses would qualify for it. So they would come up with sourcing for different various other types of businesses. Now let's try to understand what is the effect of this revenue sourcing rules on the taxing right. I'll try to give a very simple example here. We are all used to the current tax treaty rules, and we know that under the tax treaty how the revenue is sourced. We just looked at on one of the slides there. So what you see on the left hand side is is a country which has a taxing right under the current treaty rules. So here in this example, we have state A, B, C, D, E, and G. They are the ones who are getting taxing right under the current treaty rules. However, when the new sourcing rules are applied, the picture could completely change. And in a hypothetical example we have taken here, the taxing rights are getting spread across all the countries, starting from A to Z, and that is based on the revenue sourcing rules which we just looked at in the previous slides. So the revenue sourcing rules effectively leads to shifting of taxing rights from one country to another country. And then comes the tax-based determination. When we in the example, what we saw was that there's a PBT which is determined, and the the PBT ratio is considered. The question is, how do we determine the PBT? Typically, when we calculate the taxable income, there are a number of adjustments which are done to book profit. to arrive at that. And then we're talking about 130 countries participating, 133 countries participating. Each country will have a separate set of allowances and disallowances. They have different rates of depreciation, they have different type of 43B provisions. So it is no problem, never possible to reconcile all of them. So what they started agreed upon is that, well, okay, let's look at the PBT as per the financial statements, audited financial statements, which are following a set of accounting standards, and the accounting standards are US gaps, the gaps following Japan, China, Hong Kong, Canada, including India and Korea, New Zealand. The accounting standards of these countries, are the one which are treated as accepted a set of accounting standards. And when the accounting standards are, when the financial statements are prepared on this basis, the PBT is to be adopted, as a starting point. There are very few adjustments to be done to this PBT number to arrive at the tax base, and the entire formula is to be calculated on that basis. Now, there's also a very interesting concept of double counting, and this happens for the reason that when we introduce a new system of amount A as the pillar one, we're not giving up the current treaty network. So the current treaty network, the current distribution of taxing right as per tax treaties would continue, and amount A allocation would be on the top of it. To very easily understand that, let's look at the diagram. Here is a case where the MNE has a presence in 8 countries. In country C3, that's the ultimate parent entity of the group. It has branches in country 4, country 6, and a subsidiary in country 8. Now, when amount A formula is applied, and when the amount A is allocated, the allocation goes to country 1, 3, 7, 4, 6, and 8. Now, if you look at carefully, we already have a physical presence in C3, C4, C6, and C8. So that means under the existing treaty rules, these 4 countries are able to levy tax, and they are also getting taxing right as per amount A. So, that's kind of a double taxing rights, ability to levy tax twice, once as per the domestic law, and second, an allocation would come from a group level working. So that's that's an issue of double counting, and they have thought of some solutions, and this is still a work in progress. One of them is marketing distribution safe harbor, and there are some couple of other workings they are trying to do. Amount B, as I explained earlier, is kind of a hardcore transparency, and they are trying to simplify the reduce transparency disputes by ensuring that a fixed return is given to in-country baseline marketing and distribution activities. So they are looking at various options as the blueprint stands now. They are looking at a low or lesser scope marketing distribution activities. Some groups have a different view. They want a wider scope, including commissioners and other agents to be included. However, the current status is that they are looking at low scope activities. And once they agree on that, they will also come with with a set of guidance as regards the return which is to be given for this routine activities. So there's a lot of work to be done. When we look at the blueprint which was published in 2020, there are several issues which are raised in the blueprint, which indicated that the framework members are working on it. And now we look at the final statement which came on 1st of July. They say that they're going to resolve these issues by the end of 2022. So there's a lot to happen on amount A. Now, a very interesting question which comes up is that how does the entire mechanism work? When we calculate income at a group level, how does the assessment happen? So there's a detailed approach for that. So The way it will be implemented is that the ultimate parent entity will do the entire working. Will apply the revenue sourcing rules. Will apply amount A formula, and we say that, and we'll say as per their working, amount A is payable in countries. Let's say 1357, and then they would file a sort of a group return, with the lead tax administration. The lead tax administration would typically be the country in which the ultimate parent entity is situated. So they will do the working, they will give how they have arrived at the number. So there's a documentation package. The entire documentation package will be submitted to the lead tax administration, and then the lead tax administration will verify it. So you just understand that these returns are not filed in the respective countries. There is a group return which is getting filed in the ultimate parent entity jurisdiction in the lead tax with the lead tax administration. So first, the lead tax administration will look at the working, and then that will be given to all the entities which are impacted, which are affected. So let's say if revenue is derived from India, then the working will be shared with the Indian authorities as well, and the Indian authorities will have an ability to accept or reject the working. And if they reject, there's a mechanism to resolve the resolution and solve the doubts. What is the mechanism? So they are contemplating two panels. One is a review panel and one is determination panel. A panel can also work like an advanced ruling. So it may happen that the SSC, or the group itself, and at least in the initial years, say that, well, we are trying to understand how it's going to work out. So they will prepare the documentation package, they will file, and will also give for, early assessment kind of a thing. So they, they get a view of the panel members. So that, these processes get merged somewhere. But the way this is going to happen is that the working can be escalated, will be reviewed by a review panel. And then, here comes as to question as to who will be there in the panel, what will be size of the panel. So one we saw is the lead tax administration. That's a country where the return will be filed. The return may pertain to, let's say, 20 countries. Okay, so the M&E group is deriving income from, let's say, 30 countries. Okay, and in reality, there are cases where it may go up to 100 countries, but let's say, this return is dealing with income from 30 countries. Now, it's very difficult to say that all the 30 countries will participate in the assessment proceedings. And that's where the concept of panel comes in. A panel would consist of, let's say 5, 7, or 10 members. The panel will be a representative panel, a representative in the sense that it would represent members from developed countries, the large countries, developing countries, the smaller countries. And there will be representation from different geographies as well. And this panel will jointly work as a group to do the assessment, to review the workings. The working of the group, the review panel may be challenged, and if that gets challenged, it goes to a determination panel, which is in the nature of an appellate authority. Again, that panel would also be a representative body. Representatives from different countries would be there on that panel. They are contemplating whether this representation should also come from outside experts. So people who are not necessarily from the revenue. They are contemplating that those experts may get involved. Of course, there are different views within the group. That's what the blueprint acknowledges, but that's not something which is on the cards. They are also exploring that whether the members or the government authorities from the affected tax jurisdiction should be there on the panel, or the panel should be completely independent. So this is how the panel formation, would be done, and the determination panel would take the final view. The final view of the determination panel as regards amount A is binding on the tax authorities of all the countries. So there's no further mechanism, appellate mechanism, that is binding on the tax authorities. However, it is possible for the MNE to say that, well, we don't agree with what is said by the determination panel, and we have a different view. And in the blueprint says that, well, in that case, the MNE may want to look at the domestic law remedies. However, the interesting part is that there's a completely detailed mechanism which is provided for the group assessment. And after this procedure, whatever amount allocation comes, that amount will be available for taxation in the respective market jurisdiction. Let's say India is getting a taxing right on say amount of 25 crores, then that tax on that 25 crores will be payable in India by the MNE group. And for that reason, they would identify a paying entity, which entity from within the group will be paying these taxes to the Indian government. That also would be determined. So this is quite interesting development. Will get complex in that sense when this gets implemented. So that's all on pillar 1. Let me spend some time on pillar 2 now. Before that, Rakesh, are we going to have some sort of Q&A at the end of it?
We can have a couple of questions if time permits, definitely. Or else we can forward you the questions and you can respond independently. Okay, fine. So then I'll kind of maintain my speed, accordingly. So I'll try to close by let's say 11:25. Okay, and if you have any questions, we can pick up after that. So let's go to pillar 2 now. Now, pillar 2 has a completely different objective. Pillar 1 was a case where the PE rules had failed for digital businesses, and that's where there was a need for coming up with new rules. That's where pillar 1 started, and then it went on to include other businesses, to include CFP, and then all the businesses. Okay, so the new rules will be applicable to all the businesses. It had a different objective altogether, and pillar 2 has again another objective. The objective of pillar 2 is twofold. One is to stop the race of tax reductions. So over a period of last maybe couple of decades, what was observed is that the countries are significantly reducing the corporate tax rates, and we have experienced this in India as well. We also reduced the tax rates. Of course, we have withdrawn all the exemptions, but the globally these things are very clearly visible trend, and they called it as a race to bottom, and the taxes are reduced to attract more and more MNEs, more and more FDIs. And the understanding is that this reduction of tax rate distorts the level playing field. The countries effectively compete for FDI, for investment, and when the countries keep on reducing the tax rate, the competition is distorted, and that distortion is probably not helping either of the countries, because all the country will tend to lose, because of this continuous reduction of taxes. MNEs, of course, they are the gainers because they have to pay lesser amount of tax. But we're talking about this group, which is 139 countries. They are the country representatives. So from a country perspective, when there's a race to reduce the tax rates, that's certainly
not good from the interest of the country. So that's the first objective. They want to reduce the rate. And second objective is that they also want to address the remaining BEPS issues, so to say. We had 15 action plans in Action 1, except, 2 or 3, they were targeting specific planning devices or specific anti-abusive structures. We also have a residuary category like, PPT, but still it is felt that there is need to have another set of rules to address the remaining BEPS issues. So, which is an aggressive planning by the MNE groups to reduce the effective tax rate. So these are the two broad objectives of Pillar 2. What does Pillar 2, whom does it apply to? Pillar 2 applies to MNE groups who are having a total consolidated group revenue of 750 million or more. And we'll have several Indian groups, which will also qualify, within this limit. So what does, what does Pillar 2 want? Pillar 2 say, now you can look at the diagram on the right hand side. Pillar 2 wants all the companies, large companies, 750 plus companies, to pay minimum tax of 15%, which is the latest agreement on that, to pay a minimum tax of 15% in whichever country they pay. So let's say under the existing mechanism, if a country is paying, say, 12% rate of tax, then that company should be paying a top-up tax of 3% to achieve the minimum tax rate of 15%. Okay, so that's the whole objective, and there are different rules to to achieve these objectives. Now, who are the entities or groups which are excluded from scope of Pillar 2? So they have realized that Pillar 2 need not be applied to all the entities, to all the business houses. So they come with this exclusion list, and these are specifically the investment funds, pension funds, government entities, international organizations, NGOs, and international shipping. This is maybe a small list of groups who are excluded from this Pillar 2. Now, of course, globally, there are several business houses, and several countries as well who wanted various exemptions, from this. And the biggest one was probably the financial services. They said that Pillar 1 is not applicable to regulated financial services, so Pillar 2 should also not be applicable. However, the agreement which stands as of now is that the exclusion is not given. Similarly, think of situations where the countries have given a long-term tax holidays, okay, and in between Pillar 2 comes in, and there would be a tax liability payable. So, this is the issue. A lot of countries, I mean, of course, now 133 countries have agreed, but there are still 6 countries which are kind of hold-out countries, and they have challenged it, saying that, well, taxing right is our sovereign right. How can someone else tell us that we must charge 15% rate of tax? Now, interestingly, the way the entire thing is structured, it's not an obligation for any country to increase the rate of tax. So, one may continue with 9% rate of tax, one may continue with 10% rate of tax. However, the balance tax, to make it 15% will be recovered by another country, and we will look at these rules as to how this happens. So there are 3 rules, and there are 4 rules. The 3 ones are the important ones. One is income inclusion rule. We'll look at this rule, which requires tax at the rate of at least 15%. There is under-taxed payment rule, UTPR, which also requires tax rate at the rate of 15%. And third rule is STTR, which is to be applied on a gross basis. So that they have given a range of 7.5 to 9%. The first 2 rates are on a net basis. And for this purpose, they have placed a lot of reliance on a CBCR mechanism, the 750 million threshold, and the grouping, etc. concept of group, concept of M&E group, all that's been borrowed from CBCR mechanism. So let's look at how income inclusion rule works. Okay. Income inclusion rule is to be applied at a jurisdiction level, and there is a jurisdiction blending. And let me explain it, with a very simple example. Let's say we are talking about this group here, wherein C Limited is the ultimate holding company. C Limited has a subsidiary in country B, B Limited, and has another step down subsidiaries, A1 Limited, A2 Limited in state A. C Limited also has a permanent establishment in state A. Now, under the jurisdiction blending, the effective tax rate is to be determined at a country level. So we look at country A, state A. In state A, you have two legal entities and a P, and there's a simple working. Because working is very simple to determine ETR. We look at basically you add up the profits and taxes paid for all three entities, and you arrive at effective rate of tax. So here in the first example, the effective rate of tax is coming to 10.08%. That means there is a shortfall, there is a top-up tax payable, and this top-up tax will be payable in country C by C Limited. Okay, so it's very interesting to see that the benefit is lower rate of tax is enjoyed in country A. The country A is charging lesser rate of tax, and the balance tax is recovered by country C from the ultimate parent entity, which is C Limited. Okay, so effectively, country A does not have an obligation to increase the rate of tax, but if they don't levy tax, the tax will be paid in some other country. Okay, so that, that's how this entire mechanism is working, and I'll not probably get into another example, but it's a very simple working process. Now, this working looks very simple, but there's a detailed guidance as to what is the covered taxes, what are covered taxes which are to be considered for this purpose, how to determine tax base, which is globe income, how to determine it, and then there's a concept of allocation of income and taxes. So while the working looks simple, but there's a lot more detailing and concepts behind this. So this is how income inclusion rule works. Now it is possible that all the countries may not accept income inclusion rule. And what happens if country C, which is the ultimate parent entity, does not adopt IRR? Okay, they say we don't want to adopt IRR. In that case, the obligation or the taxing right shifts to the second entity in the structure, which is nearer to the top. The nearer to the top in this is B Limited. B Limited, is a holding company for A1 Limited and A2 Limited. So if C Limited does not, company C does not, recover taxes from C Limited, then state B, country B, will be in a position, will have a taxing right to recover the taxes from B Limited. However, B Limited is beneficially owning income only from A1 Limited and A2 Limited. So the only for the shortfall in the in respect to A1 Limited and A2 Limited will be recovered from B Limited. Shortfall for P will not be recovered from B Limited because the P's income does not flow to B Limited. How does P's income get the shortfall in respect of P's income get recovered? That will be recovered on the basis of another rule, which is called undertaxed payment rule. Again, a very simple example of undertaxed payment rule. So the underlying presumption behind this mechanism is that the M&Es manage to reduce the effective tax rate by group transactions. So there are several intra-group transactions which happen, and these transactions are utilized for reducing the tax liability. So in a situation where IIR does not work, the tax is recovered from this group transaction under the UTPR. So in this example, we have a P Limited, which is on the top. However, in country P, there is no IIR. So P Limited, the government of country P cannot recover taxes from P Limited. And in that situation, the taxing right goes, to another countries, which is country A and country B. And how does this happen? So from the working, they arrived that the top-up tax payable in the context of CECO is 200, and in the context of DECO is 75. And there is a details of payments of 750 and 250 flowing from A1 Limited and B Limited to CECO, and the plain payments flowing from A2 Limited, A2 Co and DECO to DECO is 200 and 100. So the amount of taxes, which is shortfall for CECO and DECO is recovered from the payments which are made by these companies to CECO and DECO in the respective proportion. So this is a very simple working. The proportion of the payments is identified and the taxes are recovered from those payments. Now, how are these taxes recovered? They are recovered by disallowing the payment. So when A1 Co is making a payment of 750, to recover the taxes, the amount of 750 will be disallowed, and that will increase the liability of A1 Co in state A. Similarly, when the payment by B Co to C Co is disallowed in country B, the liability of paying tax by B Co will increase in country B. So that's how the shortfall in taxes will be recovered from A1 Co, B Co, and A2 Co. So that's a mechanism for recovery of taxes, and of course this mechanism is further influenced by the rate of tax which is charged in A1 Co and A2 Co. So this is a very simple example of under tax payment rule. The real application of this rule is going to result in a lot more complications, because it requires a cooperation from a lot of information cooperation from countries to make this rule applicable. The third rule, which is again important, is STTR, subject to tax rule. This rule targets cross-border intra-group transactions that exploit the TT provisions. So again, the presumption here is that the provisions of the tax treaties are exploited to make intra-group payments. So, and they come up with the list of transactions which are seen as a transaction which reduce taxes, which exploit the treaty provisions, and these provisions are payments towards which are linked to mobile risk asset or capital. So the risk asset and capital are mobile in that sense. They can easily be shifted from one country to another country. So the payments such as the interest, royalties are treated as a covered payment, and other payments such as franchise fees, insurance, reinsurance payments, guarantee payments, brokerage, finance fees, rent for properties, and other marketing and distribution, marketing and procurement, services. These are the payments which are treated as resulting in base erosion, and they are subject to STTR. Now, when we say subject to STTR, that means what? That means that that country B, in this example, where country B is making a payment to country A, B Limited is making a B Limited in a different country, and when the state B is given taxing right, that means B Limited will have to effectively do a withholding sort of payment when the payment is going to country A. And what will the rate of tax? The rate of tax, as we saw in the earlier slides, the range of 7.5 to 9%, and we say 7.5 to 9% because that's the range on, and that's a tax on gross basis, whereas the rate of 15% is on net basis. The difficulty here is that how will B Limited come to know that the amount which is paid to A Limited is not adequately taxed. The entire mechanism of STTR is to be applied only if the payment made is under tax, is not adequately taxed in the country of residence. And that's why this rule again would require a lot of data, a lot of understanding about what are nominal rate of tax which are payable in different countries. How is this rule be applied? This rule will be in the form of a separate standalone treaty provision. So a new provision is contemplated in a tax treaty to make these payments. Of course, the excluded entities, would not be subject to STTR, and they would come up with materiality threshold to ensure that this is restricted to large amounts and not not each and every payment is subjected to STTR. Let's come to the implementation plan. How the entire thing is going to happen, what do we expect in the future. We're expecting maybe by the end of October, final implementation plan. That's what the last statement from inclusive framework says. Yet, what is expected, again, could be a small statement. It will not be a kind of a revised version of blueprints, because that's far more in detail. That's becoming more and more clear. That we would have a sort of incremental, document which will clarify some of the things on which the agreement is yet pending. What next? On Pillar 1, there would be another MLI which is in the making and which will be released soon, maybe by the end of this year or early next year. So in 2022, some of the articles suggest that maybe latest by January, February, they will come up with a new MLI to implement Amount A. And the target is to implement the entire Pillar 1 in 2023. How does Pillar 2 get implemented? And sorry, how does Pillar 2 get implemented? Pillar 2, they would release the global model rules for implementation of GLOBE rules somewhere in 2022. They are also contemplating a GLOBE MLI to implement GLOBE rules. That there has to be a multilateral instrument to implement this. As I said earlier, there would be a separate STTR provisional tax treaty. So there will be another MLI which would be required. And then there will be a transition rules. So, we have a lot of things in the pipeline from OECD inclusive framework, which will come up for implementation of Pillar 2 in 2023. What do we see in the domestic law? In the domestic law as well, we will need specific provisions for both Pillar 1 and Pillar 2. And it's just anyone's guess. They could come in 2022 budget or 2023 budget, or it could be somewhere in between. We used to amendment acts coming in now in the last couple of years. So we have a lot more to come. In next couple of years. Of course, the deadlines are far more aggressive. And that has been acknowledged that they're ambitious deadlines, but that's what the world is looking at. With that, Rajesh, I'll stop here, and maybe I'm open to any questions.
Yeah, participants, please feel free to put your questions in the chat box, and RK will definitely love to respond to that. RK, there are currently two questions that have come up. The first one is saying that, traditionally we had royalty, which was taxing at 10 or 15% withholding tax. From there on, since this digital concept started coming up, we tried to tax online advertising at 6%. Then you have this online buy and sell at 2%. Then you have this significant economic presence being now taxed at 40%. Then we are changing the taxing rights to the consumer destination, wherein your Pillar 1 comes and says that anything above 10% has to be shared with the consumer countries. And then finally, Pillar 2 is saying that we are going to even target the safe havens and ensure that minimum 15% tax is paid by MNC. The question is why there are so many changes happening at the OECD as well as at the country level. And second, how do you see chartered accountants getting opportunity in this turmoil and the digital space?
Okay, no, that's a very valid and interesting question. One of the slides which I showed on the present in the screen, I'll bring back that slide. When we look at all this, we see a very confusing diagram, like this. About provisions kind of overriding each other and creating multiple taxing types. Let's understand. The main reason for this is that the entire world, not in the entire world, but at least 139 countries, are trying to solve this issue, which is acceptable, come up with a solution which is acceptable to all. We have seen unilateral measures. India came with the EQL, and other countries also came up with the digital taxes. But that probably led to chaos, because these taxes are not creditable in the respective jurisdictions. Okay, so the idea is that a solution should be the one which is acceptable to not all, but at least majority of the economies, so that there is a coherence which is maintained. And what we see, the changes in the domestic law is an attempt, towards that. SEP, explanation 2A, explanation 3A, equalization levy. I would see all of them as interim measures, till the time we settle on Pillar 1 globally. Okay, so these provisions need to be seen, from that perspective. The rates of tax, may appear to be, much higher and smaller, because we talk about 40% on SEP and 2% on EQL. However, they are to be seen in a different context, and then we have royalties in between. So royalties are taxed on a gross basis. FTS is taxed on a gross basis. EQL is again on a gross basis, is a portion of turnover. Whereas the rate of 40%, that's on a net basis. So the rates may be reconciled to some extent on this. Again, globally also, we see a lot of ups and downs. And that is happening because we are trying to get a political consensus. Okay, a hardcore digital, I would say, is only EDS, but it is difficult to define, or to ring fence digital. Digital is, everywhere in all the businesses. So they brought in CFP. Then it's important that the US, which is the largest economy in the world, participates in the discussion. The US does not participate, we don't, we probably go nowhere. And to include their requirements, the scope is further enlarged to all the economies, but to only 20 billion and profitability threshold thing. So that's why, we can see the pendulum is shifting from one place to another place. That's because we are trying to get stability through a political consensus.
Yeah, and how do you see chartered accountants benefiting out of this?
I would say immense scope on Pillar 2. We shouldn't say that because there is litigation, we should be happy about it. But everything is going to take time to settle down. EQL itself is creating a lot of opportunities. All these new provisions which are coming, creating opportunities. One thing, probably which is, at least I don't like, is that when this group assessment happens, in Pillar 1, a lot of work which we are doing currently in India will get shifted to Western countries, because a lot of this will be handled at the head office level by the ultimate parent entity. So the scope of work, or the scope of qualitative work which we are doing in India will reduce. In India, if we have an issue arising on PE, okay, we see the dispute going all the way up to Supreme Court, the attribution issues going to the courts. Now all these issues will be settled only by in one country, and probably Indian chartered accountants will have a lesser role to play in those proceedings.
All right, thank you. If anybody has any questions, please put in chat box. We can separately respond to it through the email. I would now request CA Deep to give a hearty vote of thanks to our dear RK.
So thank you so much, Radhakishan Rawalji. This was really very eye-opening, right from the basic of digital taxation till the end, very exhaustively covered, and I could not leave my seat even for a single minute. And quite interestingly, while it looks very complex, you have made it, make it very simple. Thank you for your time and your insightful knowledge.
Thank you very much. Thanks for the opportunity. Thank you.
Thank you.
Bye-bye.
Question, please.
Maybe we take it separately, RK, given the time constraints. We are on the top of, and our second faculty is already waiting. So maybe Pinky, would you like to take it up?
Yes, Rakeshji, tell me what to do.
No, I think Ganesh ji has joined, right? Would you like to get him introduced and we start the second session?
So Deep sir is the introduction कर रहे हैं. Deep sir.
So Rakesh, I'll just have a quick introduction of Ganesh ji. Welcome, Ganesh ji. Thank you for your time. It's our pleasure to have you here. And while one of the important topic was already covered is digital taxation, and now it is important to also understand equalization levy, which I think Ganesh ji will help us understand in depth. A very short introduction of Ganesh ji, although it's not required here. Ganesh ji has been a keen student of taxation, and he has almost 3 decades of experience with international taxation. He has been co-author of various books, one of the book being Taxation of Copyright Royalty in India, Interplay of Copyright Law and Income Tax, published in 2019. He has contributed to various professional bodies. He has contributed to the publications like GAR, MLI, International Taxation. And it will be our pleasure to hear from Ganesh ji on the interesting topic, equalization levy. Over to you, Ganesh ji. Thank you.
Yeah. Welcome, sir.
Yeah, good afternoon. Thanks a lot for the invitation to WRC. Thank you, Alshi ji. Thanks, Deepak. Thanks, Deep Kotari. Hi, Pinky ma'am. So now we have had such a good session with RK on Pillar 1, Pillar 2. This is somewhat as an extension, or let me say it's this actually preceded the Pillar 1, Pillar 2, the equalization levy. So as far as the order goes, chronologically, this should have been first, and then Pillar 1, Pillar 2 should have come up. But it doesn't matter. This is a unilateral measure. So we took, as India, we took this stand that we want to impose this levy, irrespective of what other countries do. And this was, as RK pointed out, this was a political decision and good amount of heartburn because of this unilateral levy across the world. To some extent, the Indian authorities can take credit for imposing this levy. Now we have a large number of countries who have similar levies or who are even contemplating introducing this levy. So really speaking, India has been a pathbreaker in this in this respect. Now I'll go to the subject proper. Whether I'll make the subject easy to understand or I'll make it more complex, I don't know. That we will see at the end of the session. I'll share my screen. I think is my screen visible? Okay.
Yes, sir.
Yeah, I hope you can see my slide. Yeah, I hope you can see my slides. Okay.
Okay, sir.
It's done? Yeah. Okay. So now
Yes,
we are
it's
talking about
visible.
equalization. Yeah, it is visible, right? Okay. Equalization
Yes,
levy was introduced in equalization levy was introduced in 2016. Sorry, was introduced in 2016. Before that, certain developments happened internationally. So we'll start with the story in the beginning, from the beginning. So what we had was a BEPS, sorry, what we had was a BEPS Action 1 report in 2013, which was named Addressing Tax Challenges of Digital Economy. Now, this is the entire, or rather the critical aspect of the BEPS action plan, which actually had 15 action plans. Out of this, the action plan 1 was the most crucial of all of them. The political class across the world, especially the developed world, or highly developing countries, like which is formed under the G20, they realized that the crisis which happened, the financial crisis which happened in 2008, 2009, was because you had countries being denied their due share of taxes because of companies able to manage their affairs in the existing international tax landscape by not paying tax in any country. So that was a primary issue on which this BEPS action really took birth. So if you see Action 1 report, it talks about identify the main difficulties that the digital economy poses for the application of existing international tax rules and developing detailed options to address these difficulties. What are the issues they're talking about? They're talking about the digital economy and what difficulties digital economy creates to existing international tax rules. So you have a Google Ireland earning money from India, not paying taxes in India, hardly paying any tax in Ireland, and not even being taxed in the US, where its head office is situated. So you have a situation where a company of that size and that scale not paying adequate taxes anywhere in the world. So this was a point of concern for the various political leaders of the G20, which is why they all came together to give birth to the BEPS project, the Base Erosion and Profit Shifting project. Now, this Action 1 report, unfortunately, which was the most crucial of the entire BEPS action plans, has still to find a conclusion. You still have discussion going on about Pillar 1, Pillar 2, as RK pointed out. Still, decisions are yet to be taken on those aspects. Still, we are having the world is struggling to tax such businesses which operate remotely in the market of countries. Now, what are the issues which was addressed in the Action 1 report? Largely was the agenda was issue to be examined include a significant digital presence in the economy of another country, whether it is a sufficient nexus, marketable location on relevant data, whether it creates an attribution of value, and characterizing the income derived from new business models. So these are the large aspects which was put on the plate for the BEPS Action 1 report. And Action 1 report came out of the final report in 2015, which was inconclusive. Almost 300-page report, which did not give any suggestion, any solution. All it did was it examined various options. Ultimately, it did not recommend any of them. What are the options which it examined? Was a new SEP, a significant economic presence, a withholding tax on certain types of digital transactions, and an equalization. These are the three options which they recommended. And somewhere in 2019, this digital economy emphasis got transformed into challenges from a digitalized economy, a tax challenges from to a digitalized economy. The reasoning here was basically you cannot ring fence digital economy. We use online activities for all sorts of businesses. So you can't really only tax digital economy by ring fencing it from the other economy. So you need to make it a little more broad based. So they then came to the enhanced scope, calling it tax challenges in a digitalized economy. which is effectively means what pillar 1, pillar 2 talks about, where you have a remote presence in the other country. They have identified certain in-scope businesses like your consumer-facing businesses, which are really not digital economy, but they are businesses which run remotely without having adequate presence in the source jurisdiction or in the market jurisdiction, without constituting a permanent establishment, or without constituting a strong enough nexus for that market jurisdiction to tax the profits of those companies. So this was the transformation, or this is the move from a digital economy to digitalist economy, which happened in 2019. Meanwhile, what had happened in India? So in India, of course, there have been rulings which have held that the online businesses like uploading and displaying advertisements on portal outside India as not taxable. One of the ruling, I've just given one citation. There are other rulings also. Right, florist is another one. So basically, this is not royalty when I'm paying for uploading and displaying advertisements in a Yahoo portal or a Facebook website platform. It is not royalty, nor am I hiring any equipment or website of the other party. So it comes the royalty. It is not even fees for technical services. The portal or the foreign company which owns the portal or which does the displaying of the advertisement is also not having a permanent establishment in India, so they don't suffer any tax. So this was the basic issue. Then what did happen was, after the 2015 final report on Action 1, the CBDT constituted a committee which is popularly called the e-commerce committee, and which came out with the report in February 2016. The committee recommended equalization levy of flat 6 to 8% on various types of digital transactions. So this was the precursor to an insertion of equalization levy in the Finance Act 2016, what I would call EL 1.0. So Chapter 8 of the Finance Act was introduced, which contains this levy. This levy was introduced in the Finance Act and not in the Income Tax Act, primarily to deny treaty protection to the levy. The sense that if had this levy been introduced in the Income Tax Act, it would have become part of taxes covered in treaties, and India would not have a taxing right unless there was a permanent establishment in India. So effectively, the levy would have been a non-starter had it been introduced in the Income Tax Act, which is why smartly they introduced it in the Finance Act. They called it not income tax, but a direct tax. Why did they do that? Had it been an indirect tax, it could have had a trade law implication, was the understanding of the government, which is why they called it a direct tax and not income tax. Of course, these are all labels. Ultimately, there has never been any litigation on EL 1.0. At least nothing which was reported. The companies quietly paid it, and things are going on because there's a very small component of the economy of the businesses which these companies were involved in, and this levy was on the payer, the advertiser, and not on the service provider who was actually displaying the advertisements. So since the levy was to be discharged by the payer by way of a deduction, you had people grossing up the advertising fees and discharging the levy. So the service providers, who are the real targets of this levy, were left unaffected, and it became an extra cost for the business in India who are involved in who are using advertising channels of foreign service providers. Then we'll of course go deeper into this EL 1.0. Then EL 2.0 was introduced in Finance Act 2020, which came out from the blue. There was no memorandum explaining the provisions, and there was nothing. It was not even in the finance bill of 2020 as introduced in the parliament. So what happened suddenly at the time of the enactment? This was the entire provisions of EL 2.0 was introduced. No discussion in the parliament, no discussion, no background paper available why they introduced it, but it was a surprise to all concerned. Now, this EL 2.0 expands the scope of EL considerably. This is, of course, at a lower rate, and we will discuss more about EL 2.0 going forward. There was also, after all, there was also an introduction of significant economic presence provisions, that is Explanation 2A, Wild Finance Act 2018 in the meanwhile. So basically, you had the Indian government going in overdrive to ensure that there are no window open, no escape routes open for companies who are involved uh, in the Indian markets with their remote presence. We are, of course, not going to discuss SCP today because our agenda is only the equalization levy, but this we should keep in mind. This is also as part of the total legislative landscape in India when we look at taxing digitalized economy. So you have an SCP provisions which came in 2019. Now it got postponed in 2022. They substituted the provisions Explanation 2A also in quite extensive detail. But now SCP is also live, and SCP is there in the law today, which is already active. So let's discuss EL 1.0. Now, 1.0 is basically for consideration for the EL 1.0 is at the rate of 2%, 6% on consideration for specified service received or receivable by an NR from a person resident in India carrying on business or profession. Specified services, of course, need not be utilized in that business. All that is required is a person who is carrying on business in India should be the payer, from whom the non-resident should receive consideration for the specified service. What are the specified service? So specified services are exhaustively defined: online advertisement, any provision for digital advertising space, any other facility or service for the purpose of online advertisement, and any other service to be notified. Of course, nothing has been notified, though you had the e-commerce report giving almost 18 to 20 lists of items which could on which EL could have been imposed. They did not notify any of them. This was only what was introduced in 2016. Instead, of course, they came out with EL 2.0, which covers everything and anything under the sun. So what is online? Online has been defined in the chapter in Finance Act 2016 as a facility or a service or right or benefit or access obtained through the internet or any other form of digital or telecommunication network. As you can see, it's a very wide definition, and a common understanding of the word online, we all know what it is today, and that would definitely be online, and that is what the ultimately the meaning talks about. It also talks about not only an online can be a facility, it can be a service or even a right. That I find it quite odd. How can there be an online right or benefit or access? Of course, we understand all this. If there is any point of worry, is basically what is this online right? But I can't think of any example where I could have an online right. Maybe they are looking at the right as a right of access, which word is already there in the definition. So this could be a surplusage. Now, one other point in all our interpretations, in our discussions today, we have to bear in mind that this law is new, not much precedence. There are different views of different people, and whatever we discuss today is only goes to deepen our understanding. Ultimately, we have to see how the whole thing will pan out in the courts when the provisions get interpreted. Also, there have been quite a bit of interpretation challenges in the law, especially the EL 2.0, which we will discuss when we look at that section. So we discussed specified services, online advertisement. This is basically, let us say I am listing on a TripAdvisor. So the charges I pay as a consumer, as a business to TripAdvisor would be subject to this levy. It also covers charges for listing offerings on marketplace. That will go probably under provision for digital advertising space. The advertisement is mine. which will be of my product, and that product gets displayed in the marketplace. So basically, the display in the marketplace might, well, some might argue it is not advertisement, which is why they have given it as a separate limb, provision for digital advertising space. Now, for online advertisement or display or for sale, basically we can debate, but both are covered under the definition of specified services. So it doesn't really lead us anywhere. It will be covered under either of the two. Now, suppose I'm paying charges for a higher listing. Let us say in the Google search, I can pay a premium to see that my product gets listed higher. So whether those charges will be covered, yes, I would believe so. That will cover, that will get the premium which I pay for getting a higher ranking or a higher listing would be covered under this specified services. A production or a creative fee for creating advertisement, whether it will be covered. My understanding is the word online advertisement is, of course, means an advertisement which is done online. Now, a production of the advertising clip by itself or the advertisement itself is not, it will not be covered into the specified services. A production of a clip or production of the advertisement would be merely the end product resulting would be the advertisement itself. What they talk about in the specific services is the advertising the advertisement. So I would believe something which I make, something I spend on making the advertisement or making the clip, a video clip or an audio clip, would not be covered under the specific services. Only the act of advertising the advertisement will be covered in the specific services. What are the exclusions from EL 1.0? EL is not charged when the non-resident service provider has a PE in India and the service is effectively connected to that PE. So basically what we're talking about is, let us say I have a Facebook as an example I'm giving. Let's say I'm advertising on the Facebook, and that will be covered under the Equalisation levy 1.0. But if that Facebook has got a PE in India and the advertising which I do is done through that PE, in that case, the PE is taxed in India on net basis. And the profits or the income it earns, the PE earns, as will be charged to tax in India. So there will be no EL charged on such advertisements. Only one factor we need to keep in mind: the service is to be effectively connected to that PE. In the sense, what we're talking about is not a mere collection of the advertising revenue by the PE, but the effective advertisement itself. So basically, this was one of the debates which was going on after EL 1.0 was introduced. That let's say a Facebook as a Facebook India, which collects the revenue from the customers and passes it on to EL Facebook Netherlands or Facebook US or wherever it is. Now, what will happen is basically the PE will be liable to tax in India on its income, which is attributable to the FAR analysis. FAR analysis would require its functions, assets, and risks. The risks borne by the PE would have been taken into account for attributing income to the permanent establishment. Now, if it doesn't really do the advertising activity, all it does is the collection activity from the customers. So it's the service of advertising may not be effectively connected or attributable to that PE. I'm using the word attributable and effectively connected as synonyms and interchangeably, because there have been case laws in the Income Tax Act or in the Double Tax Avoidance Treaty context. They have been held to be parametric. So if the PE is only a collecting agent and is not really involved in the advertising activity or providing the digital space, which is done by the parent, in such case, EL will continue to apply, because the EL is being the service provider. Though he has a PE in India, the service, which is the advertising service, is not effectively connected to the PE other than to collect the advertising revenue. So the extent of involvement of the PE in the advertising has to be sufficient and substantial for a service provider to claim that the specified service is effectively connected to that PE. So now going forward, aggregate consideration for specified services in a previous year is less than 1 lakh, EL will not apply. Aggregate consideration would be consideration for the entire year, or from all customers, or for all advertisements, or of all advertisements or all other specific services. Payment for specific service by a resident or a PE in India is not for the purpose of carrying on business or profession. So basically, if a customer is doing a personal ad or doing an ad which is not related to his business and is not for the purpose of his business, then EL is not leviable on that amount. PE, of course, is not defined, so you can go by the Income Tax Act definition in 92F. Collection and recovery, the responsibility has been given to the payer. He has to deduct the EL from the payment or the consideration being paid to the non-resident for towards specific services. Now, there is also an exemption or a threshold given that only where the aggregate consideration which the payer has to make is above 1 lakh rupees, that deduction obligation triggers. Now there is a grossing up provisions in the Income Tax Act under 195A. Those provisions will not apply here for the simple reason that it is not a income which we are talking about, which needs to be grossed up. It is a consideration on which levy is paid. So basically, when the customer as to the service provider says, non-resident service provider says, no, I want X amount. What you do at your end for towards the EL, I'm not concerned. So the EL amount of 6% has to be discharged by the payer, but then there's be no grossing up required. If there is a failure to deduct EL, payer is liable to pay the levy, and there's a disallowance of the consideration under Income Tax Act under 40IB. One small point, 40IB. There's a non-discrimination clause available if available in a particular tax treaty, states that you read the please look at the highlighted portion, the portion in red. Be deductible while for the purpose of determining tax profits of an enterprise. Be deductible. Enterprise is the non-resident enterprise. Be deductible under the same conditions as if they had been paid to a resident of the first mentioned state. So it's quite possible that an assessee can argue that the amount is EL is payable or EL is deductible only when the payment is to a non-resident. When I make similar payments to a resident for advertising services, I don't have to deduct EL. So as far as the payer's computation of income is concerned, the computation of profits and gains for business is concerned, he should be allowed the deduction, even if there is a failure to pay the EL. There's an argument, again, not been tested, something which can be kept in mind. And in this context, one can look at a Herbalife case. I don't have the citation readily now for TDS under the Income Tax Act 40AI, where it was held on the same logic that on the same non-discrimination clause that the deduction should be allowed. Otherwise, it will discriminate against the non-resident payee. So, how do we take questions at each stage, or how do we go about it? Deep?
So you can take at the end once
Okay,
you complete it. Yeah.
So do let me know if I'm going too fast or too slow.
Sure, sir.
Okay. So now that we have done with EL2, EL 1.0, which was quite unexciting, small, not so significant. I did not create much ripple or much litigation in the in India. Now we come to EL 2.0. As I had explained earlier, this was done without any notice. It came as a surprise. It was just sprung up on the country by introducing it under the Finance Act as enacted. So what do we have? EL 2.0 is about the charge is 2% of the amount of consideration received or receivable by an e-commerce operator for e-commerce supply or services made or provided or facilitated by it to a person resident in India, to a non-resident in specified circumstances, to a person who buys such goods or services by using an IP address located in India. So this is the basic charging provision. Now, what are the certain aspects we need to take into account? The word consideration is not defined. So can we say you go under the Contract Act meaning, so, which is basically a quid pro quo is a consideration. It doesn't say consideration due to an e-commerce operator. All it says is consideration receivable. You have to keep this in mind. It also doesn't say consideration for e-commerce supply or services. It says consideration from e-commerce supply or services. Right? So these are all certain nuances we keep in mind, which we will come back in the future slides. So I'm just pointing out these nuances to you. Whether an exchange is covered, it talks about an amount of consideration. Can we say an amount involves an amount of money? So an exchange will not be covered. I'm still not thought through this, but I just put it because it's something which struck me. But maybe one can say an exchange will not be covered, a barter will not be covered. But as I said, I'm inconclusive on that. A person resident in India, again, is another phrase which is used here, is not defined. It is defined in the Income Tax Act. One needs to see the contrast. In the SCP provisions, it talks about person in India. And in the explanation 3A, which was introduced newly on profit attribution, it talks about person who resides in India. While in equalization levy, it is clearly a person resident in India. So obviously, a person resident in India is defined under the Income Tax Act, and Chapter 8 of the Finance Act 2016 states clearly that for terms which are not defined in that chapter but defined in the Act, you go by the definition of the Act. Now, this person, like in as it was in EL 1.0, it is there is no as against what was there in EL 1.0. In EL 2.0, there is no need for the person resident in India to carry on any business. So EL 1.0 was only where the payer was in business or carrying on business, while here all persons who are resident in India are covered in this levy. Now, e-commerce operator is defined as a non-resident who owns, operates, or manages digital or electronic facility or platform for online sale of goods or online sale of provision of services or both. Now here we saw in the chart here, basically it has to be a consideration received or receivable by an e-commerce operator. This is one of the requirements for the charge to stick. So when we look at e-commerce operator definition, it has to be a non-resident who owns, operates, or manages what digital or electronic facility or platform for online sale of goods or online provision of services or both. Now here, platform, as I said, is not defined. A facility which can be used for online supply or online services is a platform, is what I would believe. It could include a domain, it could include a server. So I would believe a platform has to be viewed in a wide manner. Whether it is for the platform is adequate for online sale of goods or online provision of services or both, then it would be a platform which is covered under 164 CA. What is not covered would be a passive websites which disseminate information. So here, why will this not be covered is what we're talking about is a digital electronic facility or platform for online sale of goods or online provision of services. It doesn't cover all digital electronic facility or platform. It has to be only such platforms as are for online sale of goods or online provision of services. So a passive platform should not be used. There is one other alternative interpretation possible to say that for online sale of goods or online provision of services has to be, as qualifies the e-commerce operator, the non-resident who owns, operates, or manages the platform. But I don't think that will be the way I will read this English. I will say that the platform has to be for online sale of goods or services, and it cannot be that all platforms will be covered. But as I said, these are all issues which can come up, interpretation issues which can come up. And this, if some part of my presentation will be technical to that extent, so I think you'll have to bear with me. But we will try to keep our feet to the ground and try to understand how the provisions can be made workable, rather than to find out how we can litigate and avoid the levy altogether, because that is what the courts will do going forward. So one is, we have discussed this platform for online activities is like what is covered. What is online sale of goods? The word sale of goods is a nomen juris as held by the Supreme Court in Gannon Dunkerley. So it cannot be given any other meaning than what is the legal meaning. So legal meaning in sale of goods is contained in the Sale of Goods Act, largely, which will mean there has to be a title change for a consideration, is what is sale of goods. A rental will not be covered under sale of goods, because rental, or even for that matter transfer of right to use, will not be covered under the sale of goods, because that is not what sale of goods is under the Sale of Goods Act. But rental could be covered under provision of service if we follow the service tax law. Service tax law defines service is something being done for a consideration for another as a service. Whether we can use those definitions to interpret services in Finance Act 2016 is a question mark. But I would believe there is really no great hurdle in doing that, because otherwise how will you really give meaning to the words service? There has to be some meaning to the word service. So a rental could get covered under a provision of service, going by the understanding in the indirect tax space. Now, the words in 194O, which is the domestic e-commerce operator provisions, TDS provisions, are on supply of goods, while here we are on online sale of goods. So that itself shows that online sale of goods has to be given a legal meaning, while a supply of goods is much wider. It can be even a supply for which is returnable, like a rental. It could get covered there. So maybe that's an argument to say that when you have a provision like a supply of goods in 194O, which could cover rentals, why would, and the EL provisions do not contain such provisions, can one say rental is not covered at all? But I think that's a very aggressive way to look at it. I would rather look at it as a rental will get covered under provision of services. And when I'm using the word rental, you look at all the subscription services, what we avail of software, of music. They're all, in my understanding, they're all rental. So basically, to say that the provision fails because the word sale of goods is used and it is not sale of goods, and it is not service also, would be a very aggressive stand to take, and I don't think it will really fly. Social media platforms, yes, they are covered. When we look at the meaning of digital or electronic facility or platform. But there, what will happen is you will have a sale of advertisement will be covered under EL 1.0 and a sale of data under EL 2.0. So they could get covered under both the ELs. E-commerce supply or services is defined as online sale of goods owned by the e-commerce operator, online provision of services provided by the e-commerce operator, online sale of goods or provision of services, or both facilitated by the e-commerce operator, or any combination of the above. So they are not only looking at goods owned by the e-commerce operator or services provided by the e-commerce operator, but also facilitated by the e-commerce operator. As distinct from 194O, 194O does not include goods owned or services provided by the e-commerce operator. I'm just pointing out the distinction, not that it makes any difference in the interpretation of 164 CB. They added this explanation by the Finance Act 2021 to say that explanation for the purpose of this clause, online sale of goods or provision of services shall include one or more of the following activities: acceptance of the offer, placing of purchase order, acceptance of the purchase order, payment of consideration, and supply of goods or provision of services partly or wholly. So what they are, any of these 5 items, if is as an online activity is included in the particular transaction, it will amount to an online sale of goods. So this was one of the arguments of people in interpretation when this explanation was not there, to say that I do an online booking of a product which gets physically delivered to me. So how is it online sale of goods? The title of the goods passes only when the delivery happens to me. So there is not amount to an online sale of goods. So they have plugged it to bring even such cases into the EL 2.0 net. So even an acceptance of the offer of sale, or for that matter, a payment of a consideration, which would normally happen online, you will have EL, the supply will be covered under e-commerce supply or services definition under 164 CB. This is one thing which will again come to our mind, is like basically they have drafted the law in a hurry, and they are doing patchwork and plugging the loopholes so that the provisions so that the provisions are effective. But the point is, there are some very disjointed way in which the provisions are eventually read. So let's understand what is the consideration they talk about. What does your extent, scope, and commencement provisions of 163 say, up to chapter 8 of Finance Act 2016? That chapter shall apply to consideration received or receivable for e-commerce supply or services. While 165A, which is the charging section, says consideration received or receivable by an e-commerce operator from e-commerce supply or services. And you also have an explanation which says consideration received or receivable from e-commerce supply shall include consideration for sale of goods. So it's a quite a bit of what I would call a maze, a confusion which is created. And why I'm raising this issue is by the example which I'm giving on the right. We'll read the example and then again we'll look at these interpretations to see whether we can make some sense to read all of them harmoniously. Let's look at this. What we have is a simple example of a customer, the e-commerce operator, and FCO is the ultimate supplier of the goods. So now customer pays to the e-commerce operator. Let's take case 1, 102. E-commerce operator pays the FCO 100. EL will be on what amount? I believe 102, because the e-commerce operator receives a consideration from e-commerce supplier services, which is why the entire 102 will be subject to this levy. Now, this has been quite controversial when the EL 2.0 was introduced, and there are a lot of debates around this. And I think they have plugged the loophole or plugged the confusion by introducing your 165A3B 1 and 2, where they say consideration received or receivable shall include consideration for sale of goods, irrespective of whether ECO owns the goods, and similar provisions for services. So here, ECO does not own the goods. ECO collects the money from customer and pays to the supplier. So the money passes through ECO. ECO receives 102. Whether he owns the goods or not, it includes the consideration for the sale of goods, and he will be subject to levy on the entire 102. What is case 2? In case 2, we have a customer who pays FCO directly, 100, pays the e-commerce operator the 2, the facilitation charges. So EL will be only on 2. Here, an interpretation can be given to say that when there is a 165A3 specifically says the consideration shall include consideration for sale of goods, irrespective of whether ECO owns the goods. So an interpretation can be said that even where ECO receives only 2, he should discharge levy on 102. But I think that will be a wrong interpretation. The reason being, one is ECO does not have that money to pay the EL. it can't pay EL on 102, which will be effectively including the entire consideration of 2 it receives as EL. That is one. Second, 165A3 is not a deeming provision. It doesn't deem a consideration which was never received by ECO as a consideration for e-commerce supplier services. All it says is if the consideration includes consideration for sale of goods, then you include it while discharging the levy. So basically here in case 1, you have the consideration received of 102, which included consideration for sale of goods. So you include it in the levy. So they were plugging a loophole. Unfortunately, that has not been done with any elegance, as it is as has been told by one expert. So what we have is this sort of an interpretation. But to give a meaning to 165A3 as a deeming provision would be incorrect. It says is if you think that you will exclude a consideration received which includes consideration for the sale of goods, like here in the case 1, then you are wrong. You should include the consideration for sale of goods if you are receiving that consideration in the e-commerce consideration from the e-commerce supplier services. In case 3, what we have, customer pays FCO to the full amount. FCO is not a e-commerce operator, and ECO receives its facilitation fee from ECO. Now here the argument is consideration has to be received by an e-commerce operator. Who receives the consideration? FCO. FCO is not an e-commerce operator, so there will be no levy. Now, if ECO is an e-commerce operator, it receives money from FCO, right? Now, that whether it will be covered, we'll see in the subsequent slides. Now, before we go further, add ECO included the let's say FCO's P in India is listing the goods on the e-commerce portal, and the ECO sells it to the customers, and the customer pays 102 to ECO, and in that case, how much should be the levy applicable on? There, they have brought in a sort of a relaxation to say, consideration for sale of goods, irrespective of whether ECO owns the goods or not, which we saw the last slide. However, it shall not include consideration for sale of goods which are owned by a person resident in India or by a P in India. So obvious, the logic is FCO P would be suffering Indian taxes, would be subject to Indian taxes on net basis. So there is no point in covering the consideration it receives in the entire transaction to EL in the hands of ECO, which will amount to a double taxation and it will add to a cascading effect. So they have excluded sourcing from India from the equalization levy. So what we have in case 4 is EL will be only on the facilitation charges and not on the entire 102. Now, we saw in the earlier slide about FCO paying to ECO, whether that will get covered. Now, this is a similar example here where FCO engages ECO to provide online tech support for devices sold by it to customers in India. So let's say I go and buy a Dell laptop. Dell gives me a support for a year or 2 years, depending on the extended warranty or whatever I take. And that service is provided online, let's say from abroad. So I have a FCO which gives me that facility, and I'm in India. The facility is coming from ECO, which is an online facility. So it's an e-commerce operator which has a platform or manages a platform for supply of goods. The question is, what are money, what are consideration FCO pays to ECO, whether it will be subject to levy? Now both are non-residents. What 165A1 requires? It is consideration received or receivable by ECO from e-commerce supplier services to a person resident in India. So now ECO has received consideration, but from FCO, not from the customer. Can that be brought under the equalization levy under this provision? Of course, the customer is a person resident in India, and there is no confusion there, right? So what does e-commerce supplier services say? Online sale of goods owned by eco, online provision of services provided by eco, and the above facilitated by the eco. One thing we have to bear in mind, what we're talking about is a consideration. A consideration implies a contract. The customer is not part of the contract between FCO and ECO. There's no privity. A customer has an independent contract with FCO, on due to which it is entitled to the support, tech support. But ECO's contract with the FCO is for a consideration which ECO receives to provide a benefit to a customer in India. So what we have is a service provider. A service provider is the ECO. You have a service recipient, who's a person who pays for the service, and the beneficiary, who's a different person. So a beneficiary need not be the person who has to pay for the service. It can be somebody else. Let us be a very popular example is an authorized service station. We take our car in the warranty period to the service station. We get our car serviced free. The service station bills the car company or the manufacturer, and in that case, we are only the beneficiaries. The service provider is the service station, no doubt there. Service recipient is not the customer. Service recipient is the company, car company. So similar example, there are these issues have been litigated in the service tax regime. I've given few two judgments. Of course, one of them is the Paul Merchants is been the appeal has been admitted by the Punjab and Haryana High Court. But the ruling went in favor of the assessee on this ground to say that a beneficiary is not a service recipient if the consideration is being paid by someone else. So let's proceed. Some other variations. What is e-commerce supply or service we are talking about? In this case, we have a cruise company, and it's got you have a customer in India who books the cruise on the e-commerce portal. E-commerce portal passes on the money to the cruise company. Now, question is, on what amount will the EL apply? The consideration flows from here, from the customer to the the portal, and eco portal to the cruise company, while the customer has got a contract with the cruise company, right? The company also has a contract with the eco in the sense that the money which is received, the cruise, the service of the cruise will have to be delivered by the cruise company and not eco. But what are consideration which eco receives towards that cruise will be subject to the levy. Now, question is whether full cost of the cruise to eco will get when the full cost of the cruise is paid to the eco, what will be EL on? My understanding will be on the full cost, though it will be the cruise company which has to provide the service, where booking amount to the eco is only paid, and balance is paid on the cruise or separately to the cruise company. In that case, only on the booking amount and not on the full cost, because as far as eco is concerned, eco has received only the consideration of the booking amount, and where there's a full cost to eco paid to eco, that's case 3, and some additional expenses are incurred on the cruise. Let's say I extend my trip on the cruise, or I avail of some add-ons. In that case, on full cost, of course, I pay EL to the cruise company. The eco has to pay EL on that full cost, which the customer pays to the e-commerce operator, while on additional expenses on cruise, which is paid to the cruise co, will not be subject to the levy. So that's and my understanding will be a separate contract, and there's no part of that contract will be by way of an online activity, and online activity done on a done by an e-commerce operator, which is why I would believe on the additional expenses there should be no EL. Now, there are 3 instances we talked about where the charging section applies. Okay, we saw the 3 instances here. The charge. a person resident in India. We discussed that aspect now. We are on to the e-commerce operator. The consideration received by an e-commerce operator from e-commerce supplier services to a non-resident in specified circumstances is what we are going to discuss now. We also discussed that Dell example, right, where both are abroad. In that case, what happens? This is an example. Now we will look at that provision. Okay. Only in specified circumstances, such consideration will be subject to the levy. What are those circumstances? One, sale of advertisement which targets a customer who is resident in India, or a customer who accesses the advertisement through IP address located in India. Of course, there is no overlap with EL 1.0. In this case, we are only talking about a specific circumstances of sale of advertisement, which trigger a EL 2.0. Second instance given is a sale of data collected from a person who is resident in India or from a person who uses IP address located in India. Origin of data is to be from India. Subsequent processing of data is immaterial. As a processing of data is only taking out analysis of the data. It is not a new data, and it is talking about data collected from and not data of. It has to be collected from a person in India. It may not be of a person in India. So now that could be one nuance there. Then sale versus license of data. In case data is only licensed and not sold, whether it will be covered under the specified circumstances, I would believe yes. A sale of data is not a nomen juris as we saw for sale of goods. So we have to give it a meaning which will make it workable in terms of common parlance. Data is sold, like a lot of our data is sold, which is collected by the phone companies are being sold to people. So data is sold every day. So really speaking, it's a common parlance meaning which will have to be used and not a legal meaning. I can't say there's only a licensing of data and there's no sale, so it will not apply. I don't think that argument will succeed. Also, onward sale of data, whether it will be covered under specified circumstances, like basically what I mean is, sale of data collected from a person is covered. All that is required is the data should have an origin in India and should be origin from a person in India who is resident in India. So once the data is identified as collected from a person who is resident in India, every time the data is sold would be a trigger for the specified circumstances to happen, in which case there can be a EL on such sale. What are the exclusions in 2.0? Eco as where the e-commerce operator has got a P in India, to which the supply is effectively connected. We discussed that effective connection. Where EL 1.0 is leviable, in that case EL 2.0 will not apply. Then sales turnover or gross receipts of the e-commerce from e-commerce supplier services is less than 2 crore rupees during the previous year. These are the exclusions. Now, P is defined inclusively in the Income Tax Act. Effectively connected, we have discussed. Now we only have the sale, turnover, or gross receipts. This is an annual limit, 2 crore every year, 2 crores during the previous year. It will have, my understanding is it will exclude what is covered as a turnover under EL 1.0. It will also exclude royalty and fees for technical services taxable under the Income Tax Act, which is not part of the EL, which we'll discuss going forward. So the point is, 2 crores has to be seen in that, as we counted in that fashion, only on what is EL leviable, whether we look at the 2 crore limit. When EL is levied on either under 1.0 or 2.0, there's an exemption to the e-commerce operator or the non-resident under 1050 from Income Tax Act. The amount on which EL is chargeable gets excluded from total income under section 1050. What does it say? I'm only looking at the second part. Arising from any e-commerce supplier services made or facilitated on or after April 20 and chargeable to equalization levy under that chapter. If it is not chargeable to equalization levy, then the exemption will not apply. So what are the instances where EL will not be chargeable? So let us look at this. I brought in SCP also as a sort of to give the flavor in the presentation. Let us understand this. So where we have is EL is payable. EL payable by ECO for facilitating online sales is the provision what we have. SCP is significant economic presence is payable by NR for transactions in respect of goods, services or property with any person in India. And we discussed section 1050. And we also looked at 165A3, which says what the consideration should include. Right, now let us look at this. Resident customer paying to the e-commerce operator and which is actually supplied by the foreign company. So let's say foreign company to e-commerce operator to customer is the flow. We have e-commerce operator subject to the equalization levy, no issues. FCO, can FCO claim the benefit of section 1050? How is the word? FCO is not the e-commerce operator, but the entire consideration has suffered equalization levy. And let us say the example what we gave earlier, 102, out of which 2 is the facilitation fee of ECO, but the balance 100 goes to FCO. So in what has happened is the entire supply cost of the goods of FCO or services of FCO has suffered EL in the hands of ECO. So in such a case, can FCO also be subject to income tax in India? It cannot be subject to EL because it is not an e-commerce operator. Why income tax? Because let's say it could have SCP in India. Right. So in that case, what we have is, I believe that a harmonious reading of 1050 should include an exemption being extended to FCO. What does 1050 say? Any income arising from any specified service or any e-commerce supply or service and chargeable to levy under that chapter. Once the income is chargeable to levy under that chapter, any income arising, doesn't say to who. Right? The consideration of ECO on which it paid the equalization levy actually belongs to FCO. So it is already suffered on that consideration. So 1050 exemption should be available to FCO. Once 1050 applies, then there is an exemption from the Income Tax Act. So there is no provision, there's no question of SCP being applicable. Now, same logic, let's say instead of FCO, the supply is by FCO PE in India. So you have ECO not suffering EL on the entire consideration because the consideration which for the goods or services payable to FCO PE will be excluded. Right? In such a case, ECO will have will be charged at best only on the facilitation fee, and FCO will be subject to net basis of taxation. There are other provisions on annual returns, penalty, which I'm not going too much into detail. We still have around 7-8 slides to go, and I would like to do justice to those slides because they contain some case studies. Oh yeah, but only one point I will bring out is there's no assessment proceedings for EL. Return of EL has to be processed by the department. There's no assessment, and appeal lies only since there's no assessment. There cannot be any appeal on. There's no order, and appeal is there only against a penalty order. Penalty can be levied on non-deduction or non-payment of EL, and the penalty figures are given. The penalty provisions are given here. Appeal lies against the penalty to the CAT appeals and thereafter to the ITAC. Also, can the customer see EL 2.0 is on the e-commerce operator, it's not on the customer. But if the e-commerce operator fails to discharge the EL, can the customer be dragged into the mess by saying that customer, since you are a representative assessee of the e-commerce operator because through whom he has got the income from India, income in India, in that case, can the customer be subject to penalty and recovery of that equalization levy, because provisions of chapter 15 of the Income Tax Act apply equally to the equalization levy chapter in Finance Act. Only one point against this is basically there is no order prescribed for determining EL, and for a representative assessee to be fixed with the obligation to pay the EL, there has to be an order prescribed. But point is, can there be an order which is independent of a EL order? The jury is out. These things will be decided, will be explained by the courts as we go along. But today, there is a risk 163 could apply. As a resident, when I make a payment to a non-resident e-commerce operator, I should ensure that he discharges the EL, or at least get proper declaration and whatever is possible. I don't know how much is possible of that is possible in case of a consumer scenario. In business scenario, it should be possible. Let's go to software payments. Now, this is a simple one. We all know about the engineering analysis case, which was decided with the Supreme Court, which said that software payments for shrink-wrap software is not royalty. Now, what is the consideration? Here in our example, we have a customers in India, foreign companies abroad. There's a download of software on payment of consideration, and a EULA and a license scheme is received from FCO. This is vanilla. EL should apply. Download of software is a sale of goods, or even you might take given provision of service, it will be covered. My understanding, of course, it is sale of goods as an end user. There's a different, a little slight variation here. Let's say FCO is not dealing directly with the customers; it is doing it through a distributor or through a distribution agreement, distributorship agreement. Only the software is downloaded directly by the customer, and he gets a license key from the FCO. And customer has to sign the EULA, or the end user license agreement, with the FCO. In this scenario, what happens is you have a customer paying the distributor, of course, not subject to EL because both are Indian parties, and distributor might not be even satisfying the will not satisfy the e-commerce operator definition, not being a resident. Now, only question is when distributor makes payments to FCO, whether that can be subject to the EL. Now, the distributor can say this is a consideration. The distributorship agreement was done offline, right? There is no purchase order. There is no part of the transaction between the distributor and FCO is online. But a distributor has an obligation to supply goods to the customer, goods or services to the customer. That leg is going to be online. So to that extent, a distributor will have a risk of a EL on its payments it makes to the FCO, right? So there's one other risk which I will talk about, is basically a distributor is also getting a right under the copyright law to distribute the products. This right of distribution is a copyright right, and if there is a copyright right, and if the distributor payment is a royalty, then EL will not apply. Right? We saw in 163.3 proviso that what is taxable as royalty will not be covered under EL. So that's a controversial subject. We have a Supreme Court judgment saying otherwise, but that is there is still room to hold this view and hold this view. It's a strong view, so it is quite possible. But I just gave this variation so that we can see what is all possible going. Now we discussed royalty software payment. I'll skip that for the minute. I'll skip this also. This don't have time. Let us go to online streaming. Now here, what we have is let's say a Netflix abroad, and let's say there's a Netflix India to whom I pay the subscription fee, similar to what we saw in the software. Content is coming directly from abroad, from this e-commerce operator. FCO would be an e-commerce operator because he's owning a platform through which the streaming content is being delivered to the customer. subscription fee is paid by ICO to FCO, very similar to the distributorship agreement. Now, there is a recent news, I think it was in yesterday's Economic Times, that this issue is in the Supreme Court. Now, the argument of the ICO can be, or FCO can be, that the subscription fees is subject to a subscription agreement or a distributorship agreement, which is offline and should not be subject to the levy. And it is not a business payment and should not be subject to even Income Tax Act as royalty. But I believe if ICO is the one who is responsible for the content, FCO delivers content to the customers on account of ICO. In that case, ICO is distributing the content to the customers, which is a copyright right, which is subject to which consideration which it pays to FCO would be characterized as royalty. So EL might not apply; it could be royalty. Now this issue will come up as we go along. We will know whether the Supreme Court when the Supreme Court decides on these aspects. So now this is something we are understanding the exclusion which will be there in the EL provisions for amounts taxable as royalty or FTS in India under the Act read with the treaty. So we are looking at the nuances of looking at the provisions to understand how this provision will work. The similar words are there in section 1050 exemption. So now what this 163 provisos say, provided that the consideration received or receivable for specified services and for e-commerce supply of services shall not include consideration which are taxable as royalty or FTS in India under the Income Tax Act, read with the agreement notified under 90 or 90 days. So now let us understand what is the meaning of the word taxable as royalty or FTS. Now we have 115A, which taxes royalty, right? We have taxes income, which is royalty. We also have 44DA, which taxes royalties and FTS, where the service recipient, who's a non-resident, has got a permanent establishment in India. So under 115A, it will be a payment by a government or an Indian concern, which is covered, and payment to a non-resident by a government or an Indian concern towards royalty or FTS will be covered. So I would believe that what is taxable as royalty under the Act will be under this 115A and 44D. There are other provisions under 10(6)A exemptions and all that. I'm not getting into those because they are not really live today. Those provisions have sort of become outdated. So what we have is 115A. If there's a payment being made to a non-resident by an Indian payer, resident, in that case, that payment will be subject to payment as royalty. It will be taxed as royalty or FTS under 115A, where there is no permanent establishment of the non-resident in India, or under 44DA, where there is a permanent establishment of the non-resident in India. Now, if it is not characterized as royalty under section 916, or as defined under section 916, or as FTS as defined under section 917, in such a case, 115A will not apply, 44DA will not apply. The amount, if it is taxable in India, will be taxable not as royalty or FTS. So with this background in mind, if you read these provisions, then they will make a little sense. So what is taxable as royalty and FTS under the Act is under 115A or 44DA. Read with agreement notified under, is read with the double tax agreement. Now, do I need to look at the characterization of the payment under the treaty as royalty or FTS for this proviso to apply? I would believe no. All that is required is it should be taxable as royalty or FTS in India under the Act. It cannot be taxable under treaty because treaties do not give taxing, do not impose a charge. Treaty only allocates taxing rights between the two contracting jurisdictions. So if I read a treaty to see whether a particular item is characterized as royalty or not, as long as the allocation of taxing rights is to India, which enables taxing that income as royalty or FTS in India under the Act. In that case, this proviso is triggered. So let us understand this explanation with this table here. So there is a treaty allocates taxing rights. Let us presume there is a royalty, whether it falls under royalty under 115A or 44DA or not covered under 115A or 44DA. SCP for the moment we'll ignore. We'll just look at this. Treaty allocates taxing rights to the India, either under Article 12, 13, 21, or there is no P. But it allocates taxing rights to India when resident to non-resident. Then under the Act, it will be taxable because it is also royalty or FTS under the treaty. EL will not apply. This proviso will take you back to the domestic law, and it will be taxed under domestic law. So really, there is no option available to the non-resident to be taxed under as royalty or as EL. This was one of the issues which was argued or debated amongst the professionals, that why would I suffer 10% tax as royalty? I would rather pay 2% under EL and SK. I don't believe it is possible. This proviso was introduced after the 2000. It was introduced in by the Finance Act 2021 to plug that loophole, and it has done it quite effectively. So when there is a resident to a non-resident payment, 115A applies. In such a case, you are under Act, read to the treaty, EL will not apply. Now, let us look at a non-resident to non-resident payment. 115A, 44DA will not apply because 115A and 44DA are only payment by an Indian concern. So in such a case, EL will apply directly when there is an NR to NR payment, where treaty does not allocate taxing rights to India. I'm not on whether treaty characterizes the income as royalty or FTS. It does not only allocate taxing rights to India. In such a case, what happens? When treaty does not allocate taxing rights to India, the resident to non-resident payment, right? When treaty does not allocate taxing rates, it cannot be taxed under 115A or 44DA, right? Under the Act. So in such a case, EL will apply. So basically, what we are doing here is a particular income falls out of the tax net due to application of the treaty, which is what now EL seeks to tax. So EL is like, had this been now part of the Income Tax Act, then the issue would never have arisen at all. This whole EL provision would have been a non-starter. Same way, non-resident to non-resident payment, where taxing rates are not allocated to India, EL will apply. Where treaty allocates taxing rates to India, then again you are back to square one. Resident to non-resident payment, 150A, 44DA applies, so it will be taxable as royalty or FTS. EL will not apply. For non-resident to non-resident payment, 115A and 44DA will not apply, so EL will not apply. Your EL will not apply. Basically, you have to go under domestic law. So, if I look at the priority of application of these provisions, first I look at royalty FTS, right? Then I look at EL, and then I look at SCP. If I come from the lowest to the highest, I will first see whether there is a transaction in respect of goods, service, or property. Yes. If EL applies to it, then 1050 will exempt SCP. So the EL will superimpose over SCP, and royalty on FTS will superimpose over both. So basically, if it is a royalty or FTS is the priority, then EL and then SCP. So now what the future holds? Thank you. Yes, but what the future holds? We have discussed EL 1.0, EL 2.0. We had RK talking about the pillar 1, pillar 2 in the morning. There is a framework being developed for countries to withdraw the unilateral levies when the agreement is concluded on the taxation of digitalized businesses. If it happens, the unilateral levies will go. Question is whether countries will willingly give up the entire thing, or will the levies continue in a different name or different form? That is for the future to see. Meanwhile, there have been number of interpretational challenges in the law. That will be which are discussed now, and these challenges will now travel to the courts. I am sure that the story will be quite different for EL 2.0. Though EL 1.0 did not go to the courts at all, there was hardly any litigation. I have never heard of any litigation, forget about hardly any. EL 2.0 is not going to be the same. There is going to be litigation there. Also, the USTR investigations were initiated against the US by the US. This is basically a trade law investigation which is against which is the allegation is the levy is discriminatory against US companies. Now they have ordered some what is called countervailing actions by levying taxes on diamonds and certain other products on India, but which they have kept that as in suspension, subject to certain negotiations going on between the Indian trade authorities and the US trade authorities. So you will have huge amount of challenges possible under the trade laws. A WTO dispute resolution mechanism might be triggered. We might have a tribunal, a WTO panel being established against the levy. We might also have this aspect being discussed in the academic fora going forward, basically where the WTO requires, the WTO obligations require countries to treat the residents and the non-residents without without discrimination. So that issue is going to be also on the will be there in the agenda going forward. So I think I have finished in time. Then we have 5 minutes. We can take up questions if there are any. Thank you very much.
Yeah. Thank you, sir. Thank you so much. So that's first question that is there is whether transaction is taxable as royalty and fees for technical services. However, because of the make available clause, it is at 0 rate. Still, equalization levy comes in, or it will be exempt.
So that's the interesting portion. The plugging which they did, they plugged that loophole by the 2021 Finance Act. My understanding is you do not look at the characterization of the transaction under the treaty. You look at the characterization for the act. You look at the characterization for the treaty only to determine whether India has got the taxing rights. Now, let's say in our example, there is it is a fees for technical services, but it's not made available. There's no make available clause does not apply, which would mean India does not have the taxing right to tax that income. If India does not have the taxing right to tax that income, what we have is the income is not taxable as royalty or FTS under the Act read with the treaty. So the consequences follow. EL will apply.
Right. So second question that is there is essentially we said about pillar 1 and pillar 2, wherein if India goes and sign off on that, then equalization levy may get moved out. Now, whether that will be in totality or only restricted to the MNCs which will get impacted because of pillar 1 and 2.
So these are all discussions and debates going on in the policy circles. I would believe it will be a political decision whether to continue with the EL in some other form or to continue with EL for entities which are not covered under pillar 1, pillar 2. At the end of the day, we have to balance our budget. So if we need the money, we will stick with it. In that case, we leave ourselves also open to the consequences. The consequences are, I would believe, rather than in the income tax or the direct tax space, they are in the trade law space. I would believe that there is a good case to argue that the national treatment obligation is not being India is not fulfilling its national treatment obligation would be the acquisition of our trading partners. So we might be dragged to the WTO, and especially when in the year 2.0, year 1.0, I don't believe it is against the national treatment obligation of India, because India has not given any commitment for advertising services under the GATS scenario. If you look at the schedule of commitments under the GATS, it does not include advertising services, but India has given commitments towards online computation and computing and online services. India has given some commitment under GATS. Now, as far as the service goods are concerned, GAT is much wide. So now, if I'm going to levy something much more than the customs duty, which I've agreed as per the tariff under the GAT, it will be challenged. So today, nobody's challenging it is because there is a discussion going on how to tax these digitalized economies.
All right.
But once that conclusion has happened.
Right. Thank you so much, sir, for all the responses. Also, there will be some more questions. We will pass it on to you, and if time permits, to respond to that. In the meanwhile, we just saw that we have our past chairman, Preeti Savlaji, also attending this session. So would request her to speak a few words.
If you allow me, I want to ask one question with Ganesh ji, if you allow me.
Sure.
Sir, one thing I am facing in our audit, that the person who are doing, who are giving advertisement through Facebook, they have one account with the Facebook and they are paying online. They have to fill that account online. So at that time, how they will do for equalization levy? Generally, they are paying with their credit card, director's credit card. They are paying to recharge their account in Facebook and in LinkedIn, like the. So how we will abide by the equalization levy? How we will fulfill the provision of equalization levy? Because I don't know whether how they are paying. They are paying by their director's credit card.
So in that point case, the point is there's an advertising activity for the company which they are doing. So whoever pays it. So at the end of the day, the consideration is going from the company, maybe through the director. I would believe that it will be equalization levy 1.0 will be covered, 1.0. And 1.0 is on a deduction basis. Basically, I'm supposed to deduct and pay. So I know what I have paid. So I add my 6% and paid, discharge the equalization levy. Really, there's no great difficulty. You might have the difficulty where you have to remit the money through banking channels and 15 CACB is required. Those issues are different. But to levy, to pay the equalization levy, you just have to fill the challan and make the payment.
So we have to do gross up, because if I want to take
that we discussed. So the grossing up provisions, I believe, are only in respect to income. Here we are talking about a consideration on which EL is dischargeable. So 195A might not apply. So grossing up might not be.
Thank you so much, sir. Preeti ma'am, before we give the vote of thanks to Ganesh sir, would you like to share some of your thoughts? I think the camera got stuck. Maybe in the meanwhile, Pingiji, you can complete the vote of thanks, and then we will request Preeti ma'am to be online. Yeah.
Actually, Ganesh ji has spoken, so given his presentation on equalization levy in so lucid and simple manner, and he has covered all the provisions like applicability of equalization levy with different situations, and how to file it, annual return, who can file the return, and who should file the return at what time, and what will be the penalty if we are not complying with the deduction, and how to file the appeal, and all the provision of ITA. He's in very lucid and simple manner, he described all the things. So I think it will be beneficial for all, because for this budget it will be more covering more transaction, and every time equalization levy is a question point for every CA कि इस पे equalization levy लगेगा कि नहीं लगेगा, and how we have to follow the things, and how we have to report in our tax audit report if they are not complying the provision. So I thank you, Gopal ji, Ganesh ji, to enlighten us for this topic. And on behalf of WIRC, I want to give a hearty vote of thanks on behalf of all participants also. So I
Thank you.
request all the participants to carry with good round of applause.
Thank you.
Thank you, Ganesh.
Thank you, Ganesh. Just hold on, participants, for a couple of minutes. We have the presence of Priti ma'am, so would like to also share, because we are also having these sessions now spreaded over Sunday and also next Saturday, Sunday. So her insights may be of help. Yeah, Priti ma'am.
Thank you, Rakesh sir. Actually, due to some technical issue and battery of the laptop, I was out. But anyways, I am not holding back you. Only my gratitude that a wonderful series on this refresher course on international taxation, structured by C. Rakesh RC, our past secretary, WIRC, and Ganesh sir, dear friend, who has really enlightened on this equalization of levy. A wonderful session, and I am 100% sure all of the participants have enriched their knowledge with this session. So friends, I hope very safety and healthy going forward, and I wish that all to reach the success in their career. Thank you very much, Rakesh sir, for giving this opportunity.
Thank you, Priti ma'am. For all the participants, thank you so much. Looking forward to meet you all again tomorrow for an interesting session once again. Thanks a lot. Thank you, Gopal Ganesh sir. Thank you so much.
Thank you, sir. Thank you, sir.
Thank you. Thank you.
Thank you, Ganesh sir. Thank you, Rakesh sir.
Thank you. Thank you. Thank you.